Hello my dear CA Inter students, welcome you all to discussion about some very fantastic subject, and Shiva Teja having experience of more than 15 years in the teaching industry, and I am super experienced to take up this interesting aspect with you, that is CA Inter income tax. You might think, Shiva sir, why are you so excited? The logic is very simple. I have been in the teaching industry for last more than 15 plus years, teaching close to more than 20,000 plus students across various locations. But again, I am super excited for a simple reason, because I am going to teach you the new Income Tax Act 2025. Earlier, once upon a time in India, there was Income Tax Act 1922. Even prior to that, there was income tax. And then there has come Income Tax Act 1961, which has been there for ages together. And finally, a new era has come, that is Income Tax Act 2025. Why am I saying a new era? A new era begins for a simple reason, which I'll strongly tell you. In the old Income Tax Act 1961, there are various sections. There are close to more than 800 plus sections. And now, in the new Income Tax Act 2025, there are only 535 sections. So, number of sections have been reduced, concept has been made more simple, concept has been made more comfortable. And the government has taken enormous efforts, and they developed the new income tax portal, wherein they have given a parallel reading between the old provision and the new provision, so that the clarity will come for a new professional who has already learned the old law and trying to experience the new law. Now, students who are listening to this lecture, I would say that you guys are very much lucky enough, for a simple reason, because you guys don't know ABC of income tax right now, and you're going to learn income tax afresh. So for you, the concept is very simple. It doesn't matter whether it is 1961 Income Tax Act or it is 2025 Income Tax Act, for a simple reason, because you don't know what is the old law. When you don't know what is the old law, it doesn't make a difference for you whether it is 1961 or 2025. I know that, but I'm excited for a simple reason, because in 2025, the act has been made more simple, concise and powerful. So during our lectures, I'll take you through some interesting provisions of Income Tax Act 2025, how the tax has evolved, what is happening with income tax, and what is the simplification that has happened. I would also, in circumstances where the topic or provision comes or section comes, I would correlate with the old Income Tax Act as well, so that student will get a clarity as to what was there earlier and now what has happened, how it is made so simple. That is where it is important that a student should get a clarity of thought on this. So for that reason, I will spend some good time with you on discussion about this new Income Tax Act 2025, and some places where it is required. I will also give reference to old provisions as well. What is it actually talking about? So let's take some good conscious effort in understanding the new income tax law, that is Income Tax Act 2025. Ready with income tax rules. So first of all, before we get into the law, let's understand what is income tax and why it has come, my dear students. Because it's important that students should know why we are learning this law. I'm sure you would have heard that income tax is a kind of tax. But my first question to you, what is tax? What is tax, guys? Come on. In simple language, we always say that tax is a compulsory fee which is charged by the government. Tax is what, my dear friends? A compulsory fee which is charged by the government. And for what purpose this is charged? The logic is very simple. If government has to run, and system has to work, it is important that government requires some revenue. And the government is collecting revenue from the public in the form of tax. And the moment I say government is collecting from the public in the form of tax, students will start getting question, sir, why should I pay the tax? See, the logic is very simple. We are enjoying a lot of facilities given by the government. Of course, there are some lacuna, there are some issues. I don't deny that fact. But at the same time, government is actually trying to take a lot of effort in terms of development of infrastructure, development of hospitals, development of education, and one biggest expenditure government has got is defense. And to meet all these expenditures, to meet all these budgets, government requires revenue. And one important source of revenue for the government is nothing but tax. And let me tell you, my dear friends, there are two types of taxes in India known as direct tax and indirect tax. What are the two types of taxes? Direct tax and indirect tax. Direct tax is a tax where impact and incidence is on same person. Come on, what did I just say? Impact and incidence is on same person. Impact means who is liable to pay. Incidence means who actually pays. The person who is liable to pay, person who actually pays, both are one and the same in case of direct tax. And indirect taxes are those where the person who is liable to pay and the person who actually pays, both are different in case of indirect tax law. Come on, friends. In direct tax, what is the story? Direct tax is the tax where impact and incidence is on same person. Indirect tax is a tax where impact and incidence is on different person. I'll give a small example. A classic example for direct tax is income tax. For example, Shiva Teja has earned income, and who is liable to pay income tax is Shiva Teja only. But other way around, a classic example for indirect tax is GST. Now, let us say Shiva Teja, a chartered accountant, I provided services to some client. What I've done? I provided services to some client. When I provide service to the client, let us say I give a bill of 1 lakh rupees. I gave some service to a client and I gave a bill of 1 lakh rupees. Now on that 1 lakh, I will charge something called GST from the client. I will charge from the client. So I'll collect from the client and then pay it to the government. Same thing happens where practically would have experienced that when you go to restaurant, what happens? Restaurant owner collects GST from the customer. Who is actually liable to pay GST is the restaurant owner. I repeat once again, who is actually liable to pay GST is the restaurant owner, but he collects from the customer. Who is actually liable to pay GST is whom, sir? Restaurant owner, but he collects from customer. So person who is liable to pay is restaurant owner, person who actually pays is the customer. Person who is liable to pay is the restaurant owner, person who actually pays is the customer. That is where we say that person who is liable to pay, person who actually pays, both are one and the same in case of direct tax. But in case of indirect tax, person who is liable to pay, person who actually pays, both are different in case of indirect tax. So once again, I'll tell direct tax is a tax where impact and incidence is on same person. Indirect tax is a tax where impact and incidence is on different person. Come on, friends. What is direct tax? Direct tax is a tax where impact and incidence is on same person. Indirect tax is a tax where impact and incidence is on different person. So let's start with discussion about one wonderful topic known as basic concepts, where we'll dwell in detail about the provisions of the basics of income tax and become perfect, my dear friends. Come on, let's proceed. So friends, as I was trying to tell you very clearly, there are two types of taxes called direct tax and indirect tax. Now what is direct tax? Direct tax is a tax where impact and incidence is on same person. Direct tax is a tax where impact and incidence is on same person. And the classic example for direct tax is what, my dear friends? Income tax. Income tax is nothing but the tax which is required to be paid on the income. When I say income, it is basically means profit. Turnover is different, profit is different. Turnover basically means your sales figure. From sales, we'll reduce the purchases, we'll reduce all the expenses, then what we get is called profit. On the profit only, we pay income tax. Indirect tax is a tax where impact and incidence is on different person. That means person who is liable to pay, person who actually pays, both are different. And the classic example for that is GST. and GST stands for Goods and Services Tax. And let me tell you an interesting point here. That is, income tax is always paid on the profit what we earned. But GST is always paid on the turnover, because GST is on the sales figure. Goods and Services Tax is always required to be paid on the turnover. It is on the gross figure always. But here, one interesting point I'll tell you, my dear students, is something like this. A person will never have a pinch of paying income tax. I mean to say, pinch of paying GST. But he will always have a pinch of paying income tax. There is a logical reason why. Because GST, the burden is shifted to the customer. When there is a shifting of tax burden and it is not pinching your pocket, why will you have a pain? So pinch of pain never exists in case of GST. But the pinch of pain is always there when it comes to income tax, because it is burning our own pockets. Impact and incidence is on same person in case of income tax. Understanding, my dear friends? A very, very interesting point. Come on. Direct tax is the tax where impact and incidence is on same person. Indirect tax is the tax where impact and incidence is on different person. Let me proceed. Now, as I told you, the classic example of direct tax is income tax. And income tax is not something new creation. I told just 2 minutes back that there is Income Tax Act 2025, but it is not that before 2025 there was no income tax in India. There was some other law named as Income Tax Act 1961. Prior to that there was some other law, Income Tax Act 1922. Prior to that there was some other law related to income tax. So income tax is there since ages. And in India there was a time when British was ruling India. There was a tax close to 80-90% tax that was paid by Indians to the British government. Slowly over a system of time, slowly over the passage of time, the taxes slightly got reduced, and it reached at such stage where now there is something called basic exemption limit, where government told if your income is up to this limit, don't pay income tax. If your income is more than this limit, pay income tax. So this is not something which is newly created now. This was there since ages, even during British rule. Even British collected tax from the Indians. That used to happen since ages. This is there, but slowly government of India has made it more formalized, more systematic. And the logical reason I told you very clearly that tax is the basic source of revenue to the government to meet their expenditures. Got it? Now I'll tell you an interesting line. That is, direct taxes are, come on my dear friends, direct taxes are progressive in nature, whereas indirect taxes are regressive in nature. Very interesting two words I wrote here. Come, what are the two words I wrote here? Direct taxes are progressive in nature. Progressive means what? Higher the income, higher the tax. Lower the income, lower the tax. So very interesting concept in income tax always, because direct tax, classic example is income tax, a very common point. If you earn more income, pay more income tax. If you earn less income, pay less income tax. If you have no income, don't pay income tax. Actually very good. That's called a proper equilibrium, because a person earning higher income should pay higher percentage of tax. A person in lower income should pay lower percentage of tax. That is what is called progressive in nature. Higher the income, higher the tax. Lower the income, lower the tax. We have a percentages. That too we have a concept of slab system. Up to so and so figure, this much percentage. Beyond so and so figure, this much percentage. Beyond so and so figure, this much percentage. So like that, slabs are fixed in income tax. That shows very clearly what? If you have higher income, you have to pay higher percentage of tax. If you have lower income, you have to pay lower percentage of tax. So the percentage of tax will differ based on the amount of income. That is why we say direct taxes are progressive in nature. Higher the income, higher the rate of tax. Lower the income, lower the rate of tax. But whereas, my dear friends, indirect taxes are regressive in nature. I repeat, whereas indirect taxes are what in nature, my dear friends? Regressive in nature. Regressive in nature means whatever is your income, your tax remains same. What does that mean? I'll give a small example here. Let us say, for example, sir, Shiva Teja went to a shop to buy one shirt. And let us say for this shirt, the GST rate is 5%. Okay? Now, Mr. Mukesh Ambani went to that shop and he also wants to buy the same shirt. And the GST that will be charged to Mukesh Ambani will be 5% only. Let us say one person earning income less than Shiva Teja, he went to that shop to buy one shirt. For him also, the GST rate is 5% only. So for that person, it is 5% only. For Shiva Teja, it is 5%. And for Ambani also, it is 5%. So irrespective of the person's income, the GST rate remains same. So GST rate will not change based on the person's income capacity. So for Shiva Teja, when they told 5%, they will not tell Mr. Ambani, you have to pay GST 10%. They don't do that. Because GST, indirect tax, is always regressive in nature. Irrespective of income capacity, the tax percentage remains same. But in case of income tax, it is not like that. It is progressive in nature. Higher the income, higher the rate of tax. Lower the income, lower the rate of tax. Very clear-cut point. No doubt about it. Come on, let me proceed, my dear friends. CA Income Tax, Chapter 1, Basic Concepts. This chapter lays foundation for a lot of interesting things. We will talk about what are the types of taxes, what is income tax law, who is a person, who is an assessee, what is income, what is tax year, apply the charge of income tax, how do we compute total income, how do we compute the tax liability. And there is something called default tax regime and optional tax regime. What is that? That also we'll talk. Don't worry, I'll teach you very soon. So let's empower with some great tax knowledge. Come on, enjoy guys. Happy learning. What is New Income Tax Act? I'll come there. Very soon I'll talk about it. But first let me talk about what is tax. Let's talk about some brief provisions of tax first. Then I'll get to income tax. What is tax? As I told, tax is a compulsory contribution charged by the government on a product, service, income, wealth or activity. It is not a voluntary payment but an enforced contribution. I like this word, enforced contribution. That is where in my language I clearly told tax is a mandatory fee levied by the government. So it is not optional, it is mandatory. Enforced contribution levied under the authority of the law. Example, income tax, GST, customs duty, etc. Why are taxes levied? Taxes are the basic source of revenue to the government. These revenue funds government expenditure on defense, education, health, care and infrastructure such as roads, dams, etc. So government, if they have to spend money, they need some source of income, right? So the source of revenue is nothing but tax. You would have seen that when some road repair work is going on or when some flyover is being constructed, they put up small barricades. And on that barricades, they write that word, your taxes are at work. I'm not sure whether you have seen or not, but some of you would have seen where they clearly write, your taxes are at work. So that shows that our taxes, what we paid, is there in that. Understood? Exactly. Next slide. Power to levy taxes. Constitution of India empowers government to levy taxes. I don't think I need to tell you what is Constitution. It's a guiding principle in India, which is the mother of all the laws and framework beyond any law. Article 265. In Constitution, my dear friends, we never have section numbers. We have article numbers. I repeat, in Constitution, we don't have section numbers. We have something called article numbers. Article 265 provides that no tax, what is that line? No tax shall be levied or collected except by authority of the law. So that means what? Any tax cannot be levied except by authority of the law. So unless law gives power, government cannot levy any tax. What is the article number? Article 265 provides that no tax shall be levied or collected except by authority of the law. So unless law gives powers, any tax cannot be levied or collected. Next line. The 7th schedule contains 3 lists distributing the power of levy of taxes between central government as well as state government. So let me highlight that point here. Which schedule, my dear friends? 7th schedule. Talks about power given to government to levy taxes. In 7th schedule, my dear friends, there is something called union list, state list, concurrent list. Now, union list contains those matters on which power to levy is exclusively with central government. Exclusive with what, my dear friends? Central government. In fact, there is something called entry number 82. Entry number 82 of union list of 7th schedule to the Constitution of India has given power to the government to levy income tax. Come, what did I just say? Entry number 82 of union list of 7th schedule to the Constitution of India has given power to the government to levy income tax. State list contains, answer only says, matters on which power is exclusively with state government. And the classic example for this is, my dear friends, tax on alcoholic liquor for human consumption. Let me tell you, tax on alcohol liquor for human consumption, exclusive power is there with state government only. Even GST also does not apply for alcohol liquor for human consumption. In GST definition only they have given that GST is a tax on supply of all goods or services or both except alcoholic liquor for human consumption. So on alcohol liquor for human consumption, GST will not apply. Their power is exclusively with state government only. And finally, concurrent list contains those matters on which power is with central government and state government together. So union list contains those taxes which are levied by central government, and state list contains those taxes which are levied by state government. Concurrent list contains those taxes which are levied by center and state together. So center and state together will levy those which are contained in concurrent list. A classic example for center and state together is nothing but GST. You would have seen in any kind of invoice where there is something called CGST and SGST. What is that? CGST and SGST. CGST is central GST, SGST is state GST. Both are levied in a particular transaction. Got it right? Exactly. So 7th schedule contains how many lists, my dear friends? 3 lists. What are 3 lists? Union list, state list and concurrent list. Union list contains those where power is exclusively with central government. State list contains those where power is exclusively with state government. Concurrent list contains those matters. What is that line? Concurrent list contains those matters on which power is with center and state together. Center and state together will take care in case of concurrent list. Only state in case of state list. And in case of union list, power is exclusively with central government. I am sure we are getting clarity on this point. Come on, get back. How is a tax levied? Each tax is levied through a special act passed for that purpose. It is first introduced as bill in the parliament and then becomes an act after receiving the assent of president. In this context, let me highlight something interesting. Sir, what happens practically is, I am sure you all know this, but still it's my duty to tell. That is, every year, government presents budget. This budget is presented in the open house. Earlier it used to be on the last day of February, which has been changed to first day of February. First day of February, government always presents the budget. This budget becomes finance bill. How it becomes finance bill? This finance bill approved by Lok Sabha and Rajya Sabha. I don't think I have to explain what is that. Upper house, lower house. Lower house is Lok Sabha, upper house is Rajya Sabha. Lok Sabha members are elected, Rajya Sabha members are nominated. I'm sure you all know this. Yeah? So finance bill is approved, then approved by members of Lok Sabha and Rajya Sabha, and post that it is signed by President. Once it is signed by President, my dear friends, that finance bill will become Finance Act. So first starting point is budget. Budget is presented in the parliament and it becomes a finance bill on approval by Lok Sabha and Rajya Sabha. Post that any corrections to be done, they'll do it. Then it is approved by President. That is when it becomes Finance Act. So the interesting point is whatever is there in budget need not be there in finance bill. And whatever is there in finance bill need not be there in Finance Act. So a lot of times practically I have seen where finance bill some items are there and 1-2 points are removed when it has become Finance Act. Sir, apart from teaching, Shiva Teja is also a CA in practice. I am a partner with one reputed firm and I am in practice for last more than 13 plus years. Almost 14 plus years. Almost 14 plus years I am in practice. So we have deal lot of practical issues and I deal only with taxation, income tax and GST. I don't do anything other than tax. So for past 15 plus years I have been seeing 14 plus years as to how this situation is happening. So a lot of times it has so happened that in finance bill there are a lot of interesting points and 1-2 points have been removed by the time it has become Finance Act. Because it has been not passed through the houses of parliament or it has not been passed through President. Understood? Done. Next. The approved act is published in the official Gazette of India and is enforced from the date specified. They clearly specify from which date this law is effective. Now, next line. What are the types of taxes, my dear friends? Taxes are classified on the basis of impact and incidence. I repeat again, taxes are classified on the basis of impact and incidence. Impact means who is liable to pay. Incidence means who actually pays. Now see here. Direct tax is the tax where impact and incidence is on same person. A classic example, income tax. There is no shifting of tax burden. Indirect tax is the tax where impact and incidence is on different persons. Example, GST, customs duty, and the burden is shifted to the consumer. So direct tax is the tax where impact and incidence is on same person and the taxpayer directly out of his income or wealth. There is no shifting of burden. And indirect tax is the tax where impact and incidence lie on different person and the burden is shifted to the consumer who ultimately consumes the goods or services. Example, GST, customs duty. Are we getting clarity? Next. How are direct taxes levied? Direct taxes are levied through Income Tax Act 2025. Here, I need to tell some important thing. Since past so many years, my dear friends, there has been Income Tax Act 1961. Income Tax Act which year? 1961. And this particular act has contained 800 plus sections, my dear friends. There was something called ATC, ATD, ATDD, DDB, QQB, RRB, ATU, TTA, TTB, whatnot. So many sections were there, so many clauses were there, so many subsections were there. That was becoming complicated day by day, day by day, day by day. Then government has thought it is important that we make some simple act and simple provisions wherein it becomes, things become more concise, things become more easy, and there will not be any BB, CC, DD and all, so that things will become easy for the person reading the law. That is where evolution has taken place after a lot of effort by the government. After a lot of effort by the government, they have finally brought Income Tax Act 2025, which has close to 535 sections. So a lot of sections have been reduced and made it more simple. And this Income Tax Act 2025, my dear friends, is effective from 1st April 2026. It is Income Tax Act 2025, but the effective date they gave is 1st April 2026 because government has framed the law in 2025, but they gave 1 year cushion time for the people to accept the law, understand the law and implement the law. That's where they told this is effective from 1st April 2026. Got it? And to support this Income Tax Act 2025, they have also introduced Income Tax Rules 2026. And this is also effective from 1st April 2026. Got it, guys? Come on. See some interesting line here. The previous page. In the first page, see something. From 1st April 2026, the Income Tax Act 1961 stands replaced by Income Tax Act 2025, which has close to 535 sections. In fact, initially when the law was framed, there was 536 sections. They removed 2 sections and added 1 section. That is where technically it has become 536 minus 2 plus 1, which has become 535 sections and 22 chapters. So basically what is happening here is Act is divided into chapters, and in chapters we have various sections. So Act is divided into various chapters. Chapters are divided into various sections. Now don't tell, sir, KGF chapter 1, chapter 2, something like that. Yeah, something like that only. So in Act, there are some chapters. So each chapter talks about some specific scenario like TDS, TCS 1 chapter, deductions 1 chapter, heads of income 1 chapter, and in chapter there are various sections. The tax rates, deductions and exemptions remain the same. What has changed is the structure, language and section number. But the point to be very clear is, for you, everything is new. Because anyways you don't know old Income Tax Act. So what difference it makes for you? So everything is new for you. Everything is new, right? See, the problem in life is more when you have to unlearn and relearn. See my example. Since past so many years, very much well versed with old section numbers. On fingertips, I have all the section numbers. I can just like that continuously keep telling all old section numbers. Without a second break, I can tell close to more than 200 plus sections just like that. Just like that I can tell. But now what I have done, I have unlearned that old sections and I have relearned the new sections. Unlearn and again freshly learn the new sections. But in your case, it's not like that. In your case, everything is new. So happily learn. Got it right? Yeah. The biggest conceptual change is concept of previous year assessment year, a single unified tax year. What is that? I'll explain to you. Don't worry. I'll explain. Don't worry. Next. Get back is. Direct taxes are levied through Income Tax Act 2025 enacted by central government. The new act came into force on 1st April 2026, replacing the Income Tax Act 1961, which governed for over 6 decades from 1st April 1962. The act is amended year on year. Year on year, some changes keep happening to the law by the Finance Act based on the budget presented by the Finance Minister. I already told budget becomes Finance Bill, Finance will become Finance Act. Clear? So friends, let me revise once what we have done till now. What is tax? Tax is a compulsory fee charged by the government. And there are 2 types of taxes, direct tax and indirect tax. Direct tax is a tax where impact and incidence is on same person. Indirect tax is a tax where impact and incidence is on different person. And what is the point here? Article 265 says no tax shall be levied or collected except by authority of the law. And Constitution in 7th schedule has given 3 lists: union list, state list, concurrent list, which has given power to levy. Union list contains matters on which power is exclusively with central government. State list contains matters on which power is exclusively with state government. Concurrent list contains those matters on which power is there with central and state together. Clear? Get back. Structure of, next slide. Structure of Indian income tax law. Entry number 82 of Union List of the 7th schedule. Central government is empowered to levy tax on all income other than agricultural income. If a person has only agricultural income, he is not required to pay any tax. But along with agricultural income, he also has some other income. Then definitely is required to pay the tax. How? We'll talk in detail separately. The sources of income tax law are as under. Friends, let me tell you, there are 5 sources of income tax law. I'll write here first, then we'll talk in detail. There are 5 sources for income tax law. And the first source is, of course, Income Tax Act 2025. Next one, Income Tax Rules 2026. Next one, Annual Finance Act, which is year on year, what are the changes done? Changes done to the act is done through Annual Finance Act, which is through form of what? Budget, Finance Bill, Finance Act. We have understood that story. Next one, Circulars and Notifications. Now what is circular? Sir, let me tell you. That is, circular is like a clarification generally. And notification is basically, name only says notification. For example, to notify some rate or notify some date. And who will give these circulars and notification? That is important. Let me tell you, my dear friends, these circulars and notifications, I repeat one more time, these circulars and notification are given by CBDT, my dear friends. One more time I repeat, circulars and notifications are given by CBDT. CBDT stands for Central Board of Direct Taxes. Come on friends, what does CBDT stands for? CBDT stands for Central Board of Direct Taxes, my dear friends. It is under Ministry of Finance. In India, we have a Ministry of Finance, Finance Ministry. I didn't tell Finance Minister. Who is Finance Minister? We all know. But there is Ministry of Finance. Under Ministry of Finance, there is CBDT, Central Board of Direct Taxes. They will issue this circulars and notifications. So what are the 5 sources of income tax law? Income Tax Act 2025, Income Tax Rules 2026, Annual Finance Act, circulars and notifications. Finally, the last one, judicial pronouncements. What is that line? Judicial pronouncements. Judicial pronouncements is nothing but basically name only says judicial pronouncements. Judicial means what? Court. Rulings of High Court or Supreme Court. We know High Court, state level, Supreme Court, all India level. And Supreme Court is always known as the apex court in India. Whatever Supreme Court passes ruling, that is regarded as the law. So whenever any provision in the act is not clear, and we are telling this is what is the meaning of it, government is telling no, that is not the meaning, this is the meaning. So person will not keep quiet. He will go to the court of law and file a case. And final rulings will come. So this ruling is also one source for income tax law. So the 5 sources of income tax law are Income Tax Act 2025, Income Tax Rules 2026, Annual Finance Act, circulars and notifications, judicial pronouncements. So the first one is what? Income Tax Act 2025. Income tax in India is governed by Income Tax Act 2025, which is in force from 1st April 2026. It extends to whole of India and provides for determination of taxable income, tax liability, and the procedure for assessment, appeals, penalties and prosecution. The Finance Act brings annual amendments to the Act. Annual Finance Act. Finance Minister presents the Finance Bill in both houses of the Parliament, Lok Sabha and Rajya Sabha, usually on the first working day of February. Part A of the budget, let me highlight. Part A of the budget contains the government fiscal policies and Part B contains the detailed tax proposal. Fiscal policy basically means what proposal government has. For example, they want to allocate 1000 crores to this, 500 crores to this, 2000 crores to this. They will tell the budget allocation policy for various purposes. And Part B contains detailed tax proposals. Once approved by Parliament, I repeat, once approved by Parliament and assented to by the President, it becomes the Finance Act, my dear friends, amending both the direct and indirect tax laws. The first schedule to the Finance Act, what is that line? First schedule to the Finance Act has 4 parts specifying the rates of tax. Number 1, rates of income tax for the current tax year. Next one, rates of TDS, tax deductible at source, for the current financial year. Friends, TDS concept is something like if a person X is making payment to person Y. If a person X is making payment to person Y, at the time of payment itself, you deduct something. At the time of payment itself, you deduct something and pay to the government. That is called tax deducted at source. And there are various cases where this TDS concept is applicable. And the whole idea behind the concept of TDS is government is telling, I will not wait. When a transaction is happening only, I want some share. And I also want to track the transaction. I want to check the transaction. I want to keep my eyes on the transaction. That's where they brought this concept of TDS. Next. Rates of TDS from salaries and for computing advance tax. Advance tax is nothing but a tax that is required to be paid in advance in installments. How many installments? We'll talk in detail. But during the year only, we are to estimate the income. During the year only, we have to estimate our income, estimate our tax and pay the tax in advance. That is called advance tax. Rules for computing net agricultural income. What is that? We'll talk in detail. Next. Income tax rules 2026. Direct tax are administered by CBDT and CBDT is empowered. Empowered means power has been given to them to frame rules to carry out the purposes of the Act. Income tax rules 1962 stand replaced by Income tax rules 2026 effective alongside the new Act. All forms, what is there in the rules? That's a question what you will get right. All the forms, procedures and valuation principles. I repeat once again. All the forms, procedure and valuation principles are prescribed in these rules. Act contains provisions. Rules contains forms, procedures and principles. Next, circulars and notifications. CBDT issues circulars and notifications from time to time to clarify the scope and meaning of provisions. Circulars are binding on the assessing officer. Assessing officer basically means the income tax officer, but not on the assessee or the courts. That means any circular which is clarification given by the government is always binding on the assessing officers. And just to give a clarity, the general hierarchy of the department goes like this. That is, there is principal, chief commissioner, and there is chief commissioner, commissioner, additional commissioner, Joint Commissioner, Additional Joint Deputy Assistant Commissioner, Assistant Commissioner. Below that you have something called ITO, which stands for Income Tax Officer, and below that there is also somebody called Inspector. This is the general hierarchy of the income tax department. And sometimes in international wing, international taxation department, the hierarchy will slightly change. You have something called Director General of Income Tax, Director of Income Tax, Additional Director of Income Tax, Joint Director of Income Tax. Like that, the hierarchy or designation is not as Commissioner, it is as Director, which is there generally in the international taxation department. Get back. Circulars are binding on whom, sir? Assessing officer, but not on the assessee or the courts. They can never override the provisions of the Act. So circular's notification cannot override the Act. So Act is the supreme. Circular notification cannot override the Act. Rules, notifications and circulars made by CBDT are together called subordinate legislation. So what are together called subordinate legislation? Rules, notifications and circulars. What is that line, my dear friends? Rules, notifications and circulars. Rules, notifications, circulars. All three put together are called subordinate legislation. Rules, notification and circulars are regarded as subordinate legislation. Next line you see. Judicial pronouncements of High Court or Supreme Court. Disputes between assessee and the department are decided by judiciary. Such decisions are known as judicial pronouncements. The Supreme Court and the High Court decide only the question of law. A question of law, other words, if you have any issue with respect to interpretation of law, you can approach the courts. The law laid by Supreme Court is the law of the land, and a High Court decision applies within its territorial jurisdiction. That means a High Court ruling will apply to that state, but Supreme Court ruling will apply to the entire country, my dear friends. Understanding everybody? Excellent. So friends, what are the 5 sources of income tax law? Income Tax Act 2025, Income Tax Rules 2026, Annual Finance Act, Circulars and Notification, Judicial Pronouncements. Friends, come on, let's move on to the next interesting point. So what is that we have done till now? What is tax? Tax is a compulsory fee charged by the government, and there are 2 types of taxes known as direct tax and indirect tax. Direct tax is the tax where impact and incidence is on same person. Indirect tax is the tax where impact and incidence is on different person. Impact means who is liable to pay. Incidence means who actually pays. And we have clearly understood that income tax is an example for direct tax, and the 5 sources of income tax law is Income Tax Act 2025, Income Tax Rules 2026, Annual Finance Act, Circulars and Notification, Judicial Pronouncements. Come on friends, let's proceed. The Income Tax Act 2025 applies to whole of India. Come on friends, Income Tax 2025 applies to what, my dear friends? Whole of India. Now the big question is, what is the meaning of this word India? Friends, let me tell you, this word India is defined in the law. Come on, see here. Section 252 defines what is India. Please see that. Section 252. Generally, my dear friends, I'll ask you one question. Listen. So let us say, for example, generally when I write 6(1), that basically means what? Section 6 and subsection 1. But in definition sections, listen very clearly here. In definition sections like 252, what I wrote now, which is for India, it is basically section 2 and clause 52. It is not subsection 52, it is clause 52. Why the difference is there? Let me explain to you. That is, subsections of a section are related, whereas clauses of a section are not related. That is why, my dear friends, in definition sections, we never use the word 252 means 2 subsection 52. It is 2 clause 52 in definition section. Rest all places, it is always subsection, clause, subclause and all. Got it? Done. Next line. Section 252 defines what is India. Come on, which section defines India? Section 252 defines what is India. India covers what? India covers territory. Territory means what? Territory basically means your landmass. India covers territory, territorial waters. Friends, territorial waters means always up to 12 nautical miles from baseline. Baseline is a place where land is done and water, that sea or ocean, begins. Up to 12 nautical miles, it is known as territorial waters. And let me tell you, 1 nautical mile is always 1.852 kilometers. 1 nautical mile in distance. Normally on road, we measure distance by kilometers. But in water, the distance is measured in the form of nautical miles. So 1 nautical mile is 1.852 kilometers. So India covers what, my dear friends? Territory, territorial waters, seabed. Seabed means what? Seabed means below the sea. Seabed and subsoil. Subsoil underlying such waters. Continental shelf and exclusive economic zone. Friends, exclusive economic zone is up to 200 nautical miles from baseline. Up to 200 nautical miles from baseline, it is known as exclusive economic zone. I repeat again, my dear friends, up to 200 nautical miles, up to 200 nautical miles from baseline, it is known as exclusive economic zone. Why it is known as exclusive economic zone? Because exclusively only one activity is covered there, that is extraction of mineral oil. I am sure you all know that extraction of mineral oil does not happen wherever you want. Clear, right? So extraction of oils, mineral oils, that activity is the only activity which is exclusively carried out in exclusive economic zone. That's where the name is exclusive economic zone. Or any other maritime zones. And the airspace, come on friends, India covers air also. Even in air, if you earn income, pay income tax. Even in water, you earn income, pay income tax. Even on land, you earn income, pay income tax. Because income tax applies to whole of India. And India covers what? Territory, territorial waters, seabed and subsoil underlying such water. Correct, no friends? Continental shelf and exclusive economic zone or any other maritime zone. And airspace, come on friends, what is covered? Airspace about territory and territorial waters. If you observe carefully, airspace, what is covered? Airspace about territory is covered. Airspace above territorial waters is covered. But airspace above exclusive economic zone is not covered. Obviously because it is common sense. Exclusive economic zone, only exclusive one activity is covered, extraction of mineral oil, which is not done from airspace. Correct, no friends? Exactly. Come on friends, India covers what? India covers territory, territorial waters, seabed and subsoil underlying such water, continental shelf, exclusive economic zone and any other maritime zone, and airspace about territory and territorial waters. So friends, what is covered in definition of India? India covers territory, territorial waters, seabed and subsoil underlying such water, continental shelf, exclusive economic zone or any other maritime zone, and airspace above territory and territorial waters. So that is the definition of India which is given by section 2 clause 52. Come back. Income tax Act 2025 applies to whole of India and came into force on 1st April 2026. Already we know this point. The tax rates for individual, partnership firm, etc. are given in the Finance Act. Certain special rates like casual income, capital gains are given in the Act itself. That means when I talk about income tax rates, the answer is what? Some rates are given in the Act itself, whereas some rates are given by Finance Act. Some rates are given in the Act itself, whereas some rates are given by what, my dear friends? Finance Act. What is that rate we are talking about? Income tax rates. What rates? We'll talk in detail, don't worry. Next. For charging the tax, the important line is residential status of a person is relevant, not the citizenship. Friends, this line is interesting. For charging tax, residential status is relevant but not citizenship. That is, taxation of a person is based on residential status, my dear friends, not based on whether you are an Indian citizen or you are not an Indian citizen. Taxation is never based on citizenship. Income tax is never based on citizenship. Income tax is always based on residential status. Residential status is determined based on duration of stay in India. In case of individuals, we will decide based on duration of stay in India. How long that person has stayed in India, based on that we will decide what is his residential status, whether he is a resident or he is a non-resident. Next chapter we are going to talk is residential status only. There we'll talk in detail about this. All rule-making, clarificatory powers delegated by the Parliament. All rule-making or clarificatory powers are delegated by the Parliament to the CBDT, which constitute subordinate legislation. Already I told you. And CBDT circulars can never override the Act. Obviously, my dear friends. Now listen. Listen. Earlier, in Income Tax Act 1961, there was a concept known as previous year and assessment year. It is important for me to tell this. You might think, sir, that is over. Why are you telling that to us? It is important for me to tell this because I have a logical reason why. Because the new thing you will appreciate better way when you know the old one. Please listen. There was a concept called previous year and assessment year. Previous year is basically the year in which income is earned. Which year you earned income, that year is called previous year. Assessment year is the year in which previous year income is chargeable to tax. Come on friends, what was the concept before? There was a concept called previous year, there was a concept called assessment year. Previous year is the year in which income is earned. Assessment year is the year in which previous year income is chargeable to tax. This was the concept which was there earlier. Now what has happened is, in the new income tax law, in other words, in the new Income Tax Act 2025, there is no concept of previous year or assessment year. There is concept of only tax year. Come on friends, there is a concept of only what year, sir? Tax year. The word is what? Tax year. There is nothing called previous year or assessment year. They removed the concept of previous year, they removed the concept of assessment year. They gave only one word called tax year. And the first tax year commencing with Income Tax Act 2025 is the tax year. Let us say, for example, when I write tax year 26-27, that means what? That means what? We are talking about financial year 26-27. And financial year always starts generally from 1st April 2026 to 31st March 2027. Because in India, we follow the concept of financial year. We don't follow the concept of calendar year Jan to December. We follow the concept of financial year April to March. So tax year 26-27 generally means 1st April 26 to 31st March 27. But let us say a business is commenced on 10th June 2026. Then tax year will be equal to 10th June 2026 to 31st March 2027. So generally it will be April to March, but if it is commenced in the middle of the year, from middle of the year till immediately following 31st March, that is called tax year. So there is no word called previous year, no word called assessment year. The only one word is tax year. The only one word is tax year. So for our understanding, for our examination purpose, the tax year we are going to learn is 26-27. Got it? Next. Definitions and basic concepts. The terms are defined in section 2 and in other specific provisions of the Act. Where a term is not defined, it is interpreted as the General Clauses Act 1897. General Clauses Act which year? 1897, or its dictionary meaning. Tax year, which section defines tax year? Section 3 defines what is tax year. As per section 3, which section? Section 3 defines what is tax year. Tax year means a period of 12 months of the financial year commencing on 1st April. Come on friends, tax year means a period of 12 months commencing on 1st April. It replaces both previous year and assessment year concept. Now see here, 1st April 26 to 31st March 27. Income is earned during the tax year 26-27. Income is earned during tax year 26-27. And income is assessed. Assessed means what? Computed after the tax year ends. Definition: income of a tax year is earned during that year and assessed after it ends. The same flow as earlier previous year, but now under a single label. That single label is called tax year. There is no word called previous year, no word called assessment year. The only word is tax year. Newly set up business. If a business or profession is newly set up or the source of income newly comes into existence, the first tax year is run from the date of setting up to 31st March of that financial year. Like the example which I gave you just now. Example, if business is commenced on 15 July 26, has its first tax year from 15 July 26 to 31st March 27. Assessment means what? The procedure by which income of an assessee is determined or computed. It may be normal assessment or a reassessment of income previously assessed. So friends, is there a word called previous year? No. Is there a word called assessment year? No. What is that word? We have only tax year. And income tax year defined by which section? Section 3 defines what is tax year. And income tax applies to whole of India. India defined by section 2, clause 52. So friends, come on. We have discussed the concept of what is income tax all about and what kind of tax is income tax. Nothing but a direct tax where impact and incidence is on same person, and income tax is governed by, there are 5 sources for income tax law, that is Income Tax Act 2025, Income Tax Rules 2026, Annual Finance Act, circulars and notifications, judicial pronouncements. And we have also very clearly discussed that once upon a time in the old Income Tax Act 1961, there was a concept of previous year and there was a concept of assessment year. And both words have now been removed and they gave only one word called tax year. What is the one word? Tax year. And tax year defined by which section? Tax year defined by section 3. And tax year is nothing but what, my dear friends? A period of 12 months of a financial year commencing on 1st April. And it replaces both previous year as well as assessment year. And one special point I told you is that if a business or profession is newly set up, then the tax year will be what? Date of setting up till 31st March. That point also we covered. I am sure we are clear with this. Very good. And income tax applies to whole of India, including Jammu and Kashmir as well, of course. And India is defined by section 252, which clearly says India covers territory, territorial waters, seabed and subsoil underlying such water, continental shelf and exclusive economic zone and any other maritime zone and airspace above territory and territorial waters. And territorial waters is up to 12 nautical miles. Exclusive economic zone is up to 200 nautical miles. We have clearly discussed this point, my dear students. Next, come on. Let me talk about who is an assessee, who is a person. First of all, I'll tell you one statement now. Listen very clearly. Let me write that so that you will enjoy that line. Listen, friends. That is, every assessee is a person. Every assessee is a person. But every person need not be an assessee. Come on, friends, what is that line? Every assessee is a person. Every assessee is a person. But every person need not be an assessee. So, first of all, before understanding who is an assessee, let's understand who is a person. And this word person is defined in the law in section 277, which defines who is a person. Please see that. Person is an inclusive definition covering 7 categories. What are covered here? Come on, please see. First one, individual. Individual is nothing but people like you and me. Individuals, we are all individuals. Next one, HUF. HUF stands for Hindu Undivided Family. This concept is existing only in case of Hindus, where they can create a HUF, that is Hindu Undivided Family, and family will have its own income and the family will be taxed separately. One separate status of recognition is given for HUF. And let me tell you an interesting point. That goes like this. That is, my dear friends, every person, see, like for example, if you are registered with your institute, you will get some roll number. In your school, you always have an admission number. So like that, everywhere there is a number that is being given. Even in income tax, you are required to get registered with the income tax department and you will get one interesting number called PAN. Most of you would have heard this word PAN, which stands for Permanent Account Number. It is a number which is allotted by Income Tax Department, for which you are required to make an application. Once you make an application, Income Tax will verify the application and allot one PAN. PAN stands for Permanent Account Number. And it is for all India only one PAN. It is not that every state you will have separate PAN. Why I am telling this dialogue? Because in GST, for every state there is separate registration. But in income tax, there is nothing like that. Income tax, it is only one number for the entire country. And that number is nothing but PAN, which stands for Permanent Account Number. And for entire India, you will have only one number. I mean to say, for that particular person, only one PAN will be there. So for example, if Shiva Teja is there, I will not have one PAN in Telangana, one PAN in Karnataka, one PAN in AP. I have only one PAN. And that PAN is valid for entire India. So from wherever I earn income in India, I require to pay income tax using that PAN only. That PAN stands for what? Permanent Account Number. And let me tell you an interesting point. that this PAN is a 10-digit alphanumeric code wherein first 5 are alphabets, next 4 are numbers, last one is again an alphabet. This is the general trend how the PAN number looks. PAN means permanent account number. Now the point to be noted here is fourth letter represents I repeat again, fourth letter represents type of person. For example, my dear friends, in case of individual, it will be P, and in case of HUF, it will be H. In case of companies, it will be C. In case of partnership firm, it will be F. In case of LLPs, it will be L. So by seeing the fourth letter, we can tell what is the type of the person. Next, one more interesting line also I'll tell. That is, fifth letter represents surname first letter. If you have PAN, you can check your PAN. Whatever is your surname, first letter, that will be there as a fifth letter. If it is a company, the first letter of the company name. If it's a partnership firm, first letter of the partnership firm name. That's how it always looks. Are we clear with this point? So by seeing the PAN, we can tell the type of the person. And what is the name, surname first letter or the company first letter. So PAN is how many digit? PAN is a 10-digit alphanumeric code. Come on friends, person defined by which section? Person defined by section 277. And person covers 7 categories. First one individual, second one HUF. HUF stands for what? Hindu Undivided Family. Next one companies. Company, a private company or a public company which is registered under Ministry of Corporate Affairs. Clear? So company means what? A private company or a public company. We know that company, right? Exactly. Next, firm or LLP, a partnership firm or LLP. And LLP stands for Limited Liability Partnership, because we all know that in case of partnership firm, the liability is joint and several. And locally we say unlimited liability. Next one, AOP or BOI. Friends, let me tell you that AOP stands for Association of Persons and BOI stands for Body of Individuals. And the classic example for body of individuals is, let us say A, B, C, D, 4 individuals have to come together and they started doing business. I repeat again, 4 individuals have come together and started doing business. They have not created a partnership firm, they have not created a company, they have not created an LLP, but they are doing business. Then we call that 4 individuals together as body of individual. And let us say one individual, one partnership firm, one company combined together, they are doing business. That individual partnership firm combined combination is known as Association of Persons. Local authority, like a municipal corporation. The last one is artificial juridical person. Artificial juridical person is like any associations, or for example, Chartered Accountants of India, ICAI, Cost Accountants of India, Company Secretaries of India, organizations. They will all come under artificial juridical person. Understood, friends? Next point. Individual means what? A natural person, a human being, including a minor. In income tax, there is no difference between minor income or major income. Whether you are a minor or you are a major, please pay income tax. There is no excuse as such. Or a person of unsound mind. A natural person, human being, including a minor or a person of what mind? Unsound mind. You would have heard in your foundation level or at your plus 2 standards that unsound mind is somebody who cannot enter into contracts. And income tax says very clearly, for me it doesn't make a difference whether you are sound or unsound. You earned income, pay income tax. You have done some robbery, you earned income, pay income tax. That's it. Income tax principle is simple. I am not concerned about legality or illegality. Whether it is legal or illegal doesn't matter to me. It is income, please pay tax. That's it. Next, HUF. Jain and Sikh undivided families are also assessed as HUF. Next, company. Indian company, foreign body corporate, or any body declared by CBDT to be company. So here companies covers Indian, foreign, every kind of company. Firm including LLP as per Indian Partnership Act and the LLP Act. For partnership it is Partnership Act, for LLP it is LLP Act, and for company it is Companies Act. AOP or BOI, trust, cooperative societies, social clubs, etc. They will all come under AOP or BOI. Trust, cooperative society, social club, etc. Local authority, example, municipalities, municipal corporation. Artificial juridical person, universities. Bar council. Bar council example is, bar council basically is for a regulatory body for advocates. ICAI, Institute of Chartered Accountants of India. Deities, temples. Basically we are talking about temples. Next one, come on, notes on persons. HUF. Under Hindu law, a family consisting of all males lineally descended from a common ancestors, including their wives and daughters. Come on friends, under Hindu law, a family consisting of all males lineally descended from a common ancestor. Grandfather is same, father is same, including their wives and daughters. A co-partner includes those sons and daughters who acquire an interest in the joint family property by birth. So in joint family property, daughters also have a right. The relation of an HUF arises from status, not from contract. HUF is not something a contract signed. A contract between husband and wife becomes HUF. There is nothing like that. It's a relationship which is coming from a status. Partition of HUF. Where property admits physical division. Physical division of property is regarded as partition. So for example, let us say 1,000 square yards land is there and there are 4 brothers. And the property is in the name of HUF. And 4 brothers are dividing 250 square yards, 250 square yards, 250 square yards, 250 square yards. That's called as a partition. Next slide. A physical division of income without physical division of property. Producing it is not a partition. To call it as a partition, there should be a physical division of property, not physical division of income. Next line. AOP or BOI. AOP is 2 or more persons who voluntarily join for a common purpose or action to earn income. Any person, company, firm, etc. can be a member. A BOI is a conglomeration of individuals only formed by operation of law. Conglomeration of what? Individual only formed by operation of law. ITO versus, in case of ITO versus Achaya, the Supreme Court ruling, sir, has held that income of an AOP is taxable only in the hands of AOP. If it's an AOP income, we will tax in the hands of AOP only. This is more for knowledge. At inter level, they will not ask case laws in the examination. They will not ask judicial pronouncements. This point I gave only for knowledge. Don't worry. Next. Local authority means what? Taxable on income from business. It carries on. Local authority example is what? Municipality or municipal corporation. Income from supply of a commodity or service. Income from what, friends? Supply of a commodity or service within its own jurisdiction is not taxable. Income from supply of water and electricity is exempt even outside jurisdiction. Municipality collects water charges, electricity charges, right? On that electricity charges, on that water charges, there is no requirement to pay income tax. Artificial juridical person, a residuary category, example, deities, bar councils and universities. So which section defines person, my dear friends? Section 277 defines who is a person. And person includes individual, HUF, company, firm, LLP, local authority. Correct, no friends? AOP, BOI and also artificial juridical person. And clearly the law started with the word, it's an inclusive definition. So person includes. That means these are anyways covered. Something else also can be covered at later point of time. Generally, there are three types of definitions: inclusive, exclusive, exact. Sometimes I will tell, for example, let us say this product includes the following. That means the following are there. Something else also is there which is not mentioned here. This product excludes the following, means following is not there, rest all is covered. And last category is called exact definition. That means this person means. If they say person means, that means only this much, nothing more, nothing less. So these are the three types of definition called inclusive, exclusive and exact. So we understood who is a person. Now let's also understand who is an assessee, because every assessee is a person, but every person need not be an assessee. Come on, say no. Who is an assessee? Important definition. Probability is there that a question can come in examination. So please see that. An assessee is any person by whom tax or any other sum is payable. That means any person who is required to pay tax, and also includes. And also what, my dear friends? Includes. Come on, who all it includes? Please see there. Every person in respect of whom any proceedings. Proceedings means what? Notice has been given by the income tax department, has been taken under the act for assessment. Assessment means calculation, computation of his income, or the loss sustained by him, loss suffered by him, or the refund due to him. Why refund will come? You are required to pay a tax of 1 lakh. You paid 1,20,000. Balance 20,000. You will claim it as refund. Come on, friends. Who is covered in assessee? Assessee means any person who is liable to pay tax, and also includes every person in respect of whom proceedings have been taken up for assessment of his income, or loss sustained by him, or refund due to him, or for assessment of income of any other person. Income of what? Any other person in respect of which he is assessable, or of the loss sustained by such other person, or refund due to such other person. I'll give a classic example for this. Sir, in income tax, there is a provision which says that if there is a minor, let me write here so that full clarity will come. Let us say there is a minor. There is a high probability that minor also earns income. Minor is below 18 years of age. Now minor has earned income out of skill, talent or manual work. Other side is any other case. Don't get it out. Sir, what is any other case? Any other case is possible. So for example, sir, Shiva Teja, I have got one minor child. Now let us say I put money in fixed deposit in the name of minor. Let us say for example, Shiva Teja has put some 10 lakh rupees in a fixed deposit for the benefit of minor. Come on, friends, what I have done? I have put 10 lakh rupees in a fixed deposit for the benefit of my minor child. Now on that 10 lakhs, interest will come or not? Definitely interest will come. On that 10 lakhs, definitely interest will come. Yes or no, my dear friends? On that 10 lakhs, definitely interest will come. On that interest, who is required to pay tax? That's a question. Now, what they told in the law is, in case of skill, talent or manual work, minor is liable to pay tax. But in any other case, what law told is, income is clubbed. Clubbed means what? Included. Income is clubbed in the hands of that parent whose income is higher. So that means that income is clubbed in the hands of father or in the hands of mother, whosever income is higher. So the income of minor child will be clubbed in the hands of father or mother, whosever income is higher. So now, for example, my dear friends, Shiva Teja has got one minor child. Now, Shiva Teja is liable for his own income, and let us say my minor child has earned some passive income, not out of skill, talent or manual work. On that income, who is responsible, who is liable, who is accessible? Of course, Shiva Teja. Of course, Shiva Teja or Mrs. Shiva Teja, whose income is higher. Getting my point, everybody? Now read the line. Full clarity will come. Assessee means what? Every person who is liable to pay tax, and also includes every person in respect of whom proceedings have been taken up for assessment of his income or the loss sustained by him or the refund due to him or assessment of income of what? Any other person. Any other person. Example, minor child. In respect of which he is assessable. That means he is responsible. Or the loss sustained by such other person or refund due to such other person. I am sure perfect clarity has come on this point. So who is an assessee, my dear friends? Assessee means any person who is liable to pay tax and also includes every person in respect of whom proceedings have been taken up for assessment of his income or loss sustained by him or refund due to him or assessment of income of any other person in respect of which he is assessable or loss sustained by such other person or refund due to such other person. Next point. Definition is not yet over. Which section defines assessee? Section 211 defines who is an assessee and what is 277 definition of person. 252 India. Next point. Every person who is deemed to be an assessee under the Act. Deemed assessee, sir. Example, agent of an non-resident. Deemed means something like assumed to be. So for example, let us say one of our student is telling he is at home preparing for his examination and is telling his mother, telling that, Ma, I'll go inside my bedroom, I'll lock my bedroom, next 3 hours I'm completely going to study, please don't come inside and disturb me, please don't knock the door. He went inside and locked the door. Now tell me, what he is doing, only he knows. But outside, mother will keep thinking what? Definitely he is studying, assumed to be studying, deemed to be studying. Clear, friends? So what is the point covered in assessee? Assessee means any person who is liable to pay tax and also includes every person in respect of whom proceedings have been taken up for assessment of his income or loss sustained by him or refund due to him or assessment of income of any other person in respect of which he is assessable or loss sustained by such other person or refund due to such other person. And assessee also covers what? Deemed assessee. Last point. Every assessee, he is deemed to be an assessee in default. So assessee also covers what? Assessee in default. Now who is assessee in default? Assessee in default covers 3 cases. Number 1, person who has not done TDS. I told you that TDS stands for tax deducted at source. In case of various transactions, for example, if A is making some payment to Mr. B, government is telling A only, while paying to Mr. B, deduct some percentage, how much we will tell, and pay that directly to the government, so that we will get some share and we will also be able to track the transaction. That concept is called tax deducted at source, TDS. So person who has not done TDS. Second situation. Person who has done TDS, TDS is done but not paid to government. He has done the TDS but kept in pocket. Then he is also called assessee in default. Last one, person who failed to pay advance tax. If you don't pay advance tax, you are also called assessee in default. Failed to pay advance tax or tax for that matter. Advance tax is a tax required to be paid in advance in installments during the tax year. So friends, assessee defined by which section? Section 211 defines who is a assessee. Assessee means every person liable to pay tax and includes what, my dear friends? Every person in respect of whom proceedings have been taken up for assessment of his income or loss sustained by him or refund due to him or assessment of income of any other person in respect of which he is assessable or loss sustained by such other person or refund due to such other person. And it also includes somebody called deemed assessee, example, agent of non-resident. And it also includes somebody called assessee in default. And friends, please tell me who is covered in assessee in default. Assessee in default covers three interesting cases. Number one, person who has not done TDS. Number two, person who has done TDS but not paid to government. Number three, person who failed to pay advance tax. These three are covered in who is an assessee in default. Clear, guys? So that's the story of assessee defined by section 211 and person defined by section 277. And as I told, please keep that point in mind very clearly that every assessee is a person, but every person need not be an assessee. So friends, what are the sections we have done till now? We have discussed 211, we have discussed 277, we have discussed 252. And 211 is what? 211 is assessee, 277 person, 252 India. Next, get back. And what is section 3, my dear friends? Section 3 defines what is the meaning of the word called tax year. Get back. Next concept, please. Section 4, charge of income tax. Income tax is charged on the total income of a tax year of every person at the rates provided by Finance Act for that year, for that tax year, or the rates provided in Income Tax Act. And I already told you some fixed rates are given in Income Tax Act and some changing rates are always given by Finance Act. And for the income chargeable, income tax shall be deduced, that is deducted actually, or collected at source or paid in advance as provided under the Act. So what does section 4 say? Income tax is charged on total income of the tax year of every person at the rate provided by Finance Act for that year or the rates provided in Income Tax Act. That's the story of section 4, charge of income tax. Generally what happens is, sir, let us say there is tax year 26-27. Generally, a person is required to pay advance tax during the year. If not paid, interest will apply. How much percentage, what percentage, we will talk in detail when I go to the chapter called advance tax. Next. On some incomes earned, payer would have done TDS. So for example, in Shiva Teja's case, Shiva Teja would have paid advance tax and some person making payment to Shiva Teja. For example, Avinash Online Learning. Avinash Online Learning is making some payment to Shiva Teja. At the time of paying payment to Shiva Teja, Avinash Online Learning will deduct some amount and then pay to me. That is not deducted means that my money is not lost. They will pay that to the government. They will pay that to the government. And which is allowed as TDS credit. Understanding, my dear friends? Now what happens is, come on, what is the tax year? 26-27. And next year, what is next year? 27-28. Next year, we file some document called return of income. Return of income is something like a statement filed with Income Tax Department. Statement filed with Income Tax Department. There are various forms like ITR 1, 2, 3, 4, 5, 6, 7 in which we fill the data and submit. What data we are giving, what is the income earned during previous year. We'll give details such as income earned during the tax year, all the details we submit in the return of income, which is a statement. Now what happens is, in the return of income, we will show details of, and doubt will come. So when do we file return of income? Generally the due date is some cases 31st July, some cases 31st August, some cases 31st October, some cases 31st November. In different case, there is a different due date to file the return. Now doubt will come in student brain. Sir, 31st July means 31st July 26, sir? No, sir. Tax year is 26-27 means next year, after year is completed, next year 31st July, we will file the return. Due date, maximum due date. Before only you have to file, but maximum due date. So in return of, what is the due date? Which case, what is the due date? We will talk in detail when I go to the chapter called return of income. So in return of income, we will show what is the total income, and on this total income, we will show what is the tax payable. From that tax payable, we will reduce advance tax because it is already paid. We will also reduce something called TDS or TCS, tax deducted at source or tax collected at source. That also will reduce. Balance, what we call, is known as self-assessment tax. So name only says self-assessment because we have only assessed. Self-assessment tax, which is paid at the time of filing return of income. At the time of filing return of income, we will pay self-assessment tax. So for example, let us say, with the number I will write here, let us say total tax payable is 1 lakh and already you paid advance tax of 50,000, and let us say there is a TDS or TCS of 30,000, balance 20,000 you will pay it as self-assessment tax at the time of filing return of income. I am sure this example is giving us some clear perspective as to what happens practically. Getting clarity, friends? So what is section 3? Section 3 defines what is tax year. Section 4, charge of income tax. Income tax is charged on total income of that tax year of every person at the rates given in Finance Act or the rates provided in Income Tax Act. Come on, friends, next point. What is the definition of this word called income? Section 249 defines what is an income. Income is an inclusive and a wide concept and covers all types of revenue. A person might get income through different ways, like salary income, rental income, sold some property, or he has got some betting income, gambling income, or he is doing some business or doing some profession. So various possibilities of income are there. Understanding, friends? And let me tell you, under income tax law, law has divided income into 5 heads of income. I repeat again, under income tax law, income is divided into 5 heads of income. The first one is called income from salaries. Second one is called income from house property. Of course, salary covers income of employee. Second one, income from house property, which is nothing but your rental income. The third one is called profits and gains from business or profession, a professional income or a business income, technically called as PGBP, profits and gains from business or profession. And there is one more thing called income from capital gains. Capital gain is what we get on sale of an asset. For example, we sold some shares or we sold some property, we sold some jewelry, any kind of situation. That is called capital gain. But jewelry case, let us say selling jewelry is your usual course of business activity. They will show in business. In simple terms, if it is stock in trade, we will show in PGBP. But if it is asset, we will show in capital gains. So what is that heads of income, my dear friends? Under income tax law, income is classified into 5 heads of income. First one, income from salaries. Second one, income from house property. Third one, profits and gains from business or profession. Fourth one is income from capital gains. And the last one is income from other sources, IFOS. And this is a residuary head of income. Why it is called residuary head of income? Because let us say there is some income. Let us say there is some income which is not covered by first 4 heads of income. There is some income which is not covered by first 4 heads of income. Then we will tax under income from other sources. And some incomes are specifically taxed in other sources like dividend income, lottery income, betting income, online games a person has played. So these kind of incomes are specifically taxed income from other sources. So for the sake of taxability, income tax has divided income into 5 heads of income. What are the 5 heads of income? Income from salaries, house property, PGBP, capital gains and other sources. Get back. Section 249 defines what is income. Income is an inclusive and wide concept and covers all types of revenue. Broad principles clarifying it include, what are the principles to call it as income? Number 1, it should be a regular and definite source. Sometimes it may not be regular also, like lottery income. Different forms of income. Receipt versus accrual. Receipt means actually received. Accrual means it is yet to be received. Next, income should be real but not fictional. Obviously, sir. Disputed title. If the dispute title is disputed, income tax department will tell till the time dispute is going on, you pay the tax. They will decide. Illegal income is taxable. Already I told. Same income cannot be taxed twice. There is no question of double taxation. Next one. Income also includes loss. There is a possibility loss also will come. When I say income, doesn't always means profit. There is a possibility of loss also. Next. Surplus from mutual activity is not taxable. Example, a club or an association. Sir, a club or association is formed by members and the income or the club of association is basically income of the club or association is basically from the members and the fund is used for a members activity only. If there something is left out, that is not called profit, that is called surplus, and the surplus is coming from a mutual activity which is not taxable. Pin money. Pin money is something like a pocket money. Don't think it is money by selling safety pins. Please. Pin money and personal gifts are not taxable. Dharmada. Dharmada basically means donations or contributions. And income also includes any assistance by way of subsidy, grant, cash incentive, duty drawback or waiver or concession or reimbursement from the government. Government is giving some subsidy, that is also covered in income unless it was already reduced from the actual cost of a depreciable asset. Now what does that mean? For example, sir, one person, Mr. X, is setting up a factory in a backward area and the machine cost is 1 crore and government gave subsidy of 25 lakhs. Now what law is telling is, when you prepare your balance sheet, you will record the asset in your books. Record the asset at 75 lakhs only because subsidy has come. If you record 75 lakhs only, that 25 lakh subsidy is not regarded as your income. Next point. Example, casual incomes that arise without regularity are also taxable. Example, winning from lottery, crossword puzzles, and also horse races. Next point, my dear friends, the concept of application of income and diversion of income. And I am sure we understood what is income. Income is defined by which section? Section 249 defines what is income. What is 211? Assessee. 277, person. 252, India. 249, income. Section 3, tax year. Section 4, charge of income tax. See next. Application of income, diversion of income. Application of income means what? Income is first received by the assessee and then it is applied or spent. It still remains taxable in his hands. For example, sir, Shiva Teja has earned income of 10 lakhs. Shiva Teja earned income of what? 10 lakhs. That entire 10 lakhs, party, and I have done party. 10 lakhs gone. Can I tell income tax? Sir, 10 lakhs has gone, sir. 1 rupee also is not left, sir. I will not pay income tax, sir. Can I tell that statement? They will not listen. They will tell what you spent is irrelevant for me. Please pay income tax on that 10 lakhs. From where you will get, I am not bothered. Get a loan and pay income tax. Next line. Diversion of income. It is by an obligation. By an obligation. And obligation is not personal obligation. It is legal obligation. By an obligation, income is diverted before it reaches assessee. By overriding title. So at source itself, it is transferred. So for example, sir, Shiva Teja has to get some income from somebody. But by way of legal obligation, I am required to pay that amount to somebody. So what I told at source is, don't give that money to me, directly transfer to some other person. So income is not coming to me at all. Income is not accruing to me at all. Because there is an overriding title. It is not my income. Title is not for me. It is not taxable in his hands. Diversion of income, diverted at source before it reaches the assessee. Application, obligation discharge after income reaches the assessee. Diversion is at the time of source itself. Application is after receipt only. And diversion of income takes place by overriding title. The title on that income is on some other person, not on Shiva Teja. No overriding title. Diversion of income not included in the income of assessee. That is the catch point. Application of income is included in the income of assessee. Diversion of income, income is not regarded as accrued or arised. But in application, income as accrued or arised and is definitely taxable. One more special point. The concept of capital receipt versus revenue receipt. Because, my dear friends, there is one golden rule of income tax, which I will tell you. Interesting, listen. Golden rule of income tax, friends. All revenue receipts are taxable unless exempt. If it is revenue in nature, that means a recurring in nature, revenue receipt, my dear friends, during the course of an activity, business activity or some other activity, regular in nature, are taxable unless it is exempt. And all capital receipts are exempt unless taxable. So it is very exempt means we will not pay tax. So it is very important to have clarity on what is revenue receipt and what is capital receipt. Capital receipt refers to a fixed capital. Example, sale of fixed asset used in business. Revenue receipt referable to circulating capital or stock in trade. Example, sale of stock in trade. Capital receipt, compensation for loss of a profit earning source. Profit earning source. I'll give a classic example, sir. Let us say if there is a property, house property. On that I am getting rental income. On that I am getting what income? Rental income. That is called revenue receipts. And let us say I sold the property only. What I get is called capital receipts. What I get from a source Source is what? House property. What I get from a source is revenue receipt. What I get by losing the source is a capital receipt, technically. Revenue receipt, compensation for loss of profit or earnings. Capital receipt is a receipt in lieu of source of income. Example, loss of employment. Revenue receipt is a receipt in lieu of income. Capital receipt is generally exempt unless taxable. Example, capital gains. Revenue receipt is generally taxable unless exempt. We have a section called section 11 which has given a list of exemptions. Which all incomes are exempt. For example, whenever let us say bomb blast occurred, government gave compensation. That is exempt. So like this there are a list of cases where it is exempt. There is one section which talks about agricultural income is exempt. Clear, friends? So whatever points we are discussing are actually very important and it makes a lot of meaningful sense. Come on, next point, guys. General rule. Income of a tax year is assessed. Assessed means what? Computed and tax is paid and return is filed. Assessed means computed and tax paid and return of income is filed. I clearly explained that to you. Income of a tax year is assessed after the year ends. After year is over, the income is assessed. But in a few cases, to safeguard the collection of taxes. For what purpose, sir? To safeguard the collection of taxes. That means what? In other words, I will tell to protect the interest of revenue. Income of a tax year is charged in the same year itself. And for that, there are 5 interesting cases, my dear friends. Let me discuss that. First one, section 316, shipping business of a non-resident. Sir, there is a non-resident. Non-resident is somebody who does not stay in India for a longer time. He is coming to India, doing shipping business and going away. Now what law is telling? You are going away. What is the guarantee this fellow will come back again? Is there a guarantee he will come back? No. So what law is telling? You go. But before you go, please pay tax and go. Before you go, what you please do? Please pay tax and then go. Shipping business of non-resident. A non-resident owner or a charter means who has taken on hire, of a ship carrying passengers or goods from an Indian port pays tax before the ship leaves. Before ship leaves India, pay tax and go. Income is deemed at 7.5% of the freight. That means technically 7.5% of turnover is deemed to be income. 7.5% is not the tax rate. 7.5% is not the tax rate, sir. 7.5% of turnover is deemed to be income. So what is the first point? Section 316, shipping business of a non-resident. Next one, section 317, persons leaving India. When I say leaving India, we are talking about not somebody who went for vacation, telling I am going for Dubai vacation for 10 days, pay tax and go. Not like that. We are talking about somebody leaving India permanently or for a long time. Long time generally means more than 1 year. If a person may leave India with no intention of returning, income up to the probable date of departure is taxed in the same year. Please pay tax and go. And practically they ask something called ITCC, which stands for Income Tax Clearance Certificate, if you are going permanently. Next, 318, AOP, BOI, AJP for a particular event. On dissolution of AOP, BOI formed for a short event, income up to date of dissolution is taxed in the same year. The logic is simple. Let us say A, B, C, D, 4 of them have come together for a short duration or purpose. They earned income. And after that 3 months, they are dividing. They are splitting away. And after 3 months, income tax is asking them to pay tax. A is telling, no, B will pay. B is telling, no, C will pay. C is telling, no, D will pay. No, A will pay. What is that time pass going on? So law told, do one thing. First pay tax, then you divide. AOP or BOI formed for a short duration or purpose. Section 318, 316, 317, 318. Next one, 319. Persons likely to transfer property to avoid the tax. If a person is likely to sell or transfer assets to avoid tax, why you might think, sir, where is the question of avoiding tax? For example, sir, a person is there who is on already, there is some income tax demand notice and he knows that if he doesn't pay income tax will take his property. So what this fellow is doing is, he is selling away that property to escape the tax. income up to the date proceedings start is taxed in that year. Finally, discontinued business. You are stopping business in the middle, section 320, you stop but pay tax and then stop. Income from a discontinued business may be taxed in the same year at the AO's discretion. The first four are mandatory. So that means in the first four cases, income of a tax year is to be taxed in the same tax year itself. But in the last case, there is a discretion for AO. AO means assessing officer. So these are the 5 cases where income of a tax year is taxed in the same tax year itself. So what are the 5 cases, my dear friends? Section 316, 317, 318, 319, 320. Shipping business of non-resident, persons leaving India permanently or for long time, AOP, BOI, AJP formed for short duration or purpose. Correct? No, my dear friends. Come on, speak out. Person likely to transfer property to avoid tax, discontinued business. 316, 317, 318, 319, 320. What is 316, my dear friends? Shipping business of non-resident. Next one, 317, persons living India permanently or for long time. 318, AOP, BOI, AJP formed for short duration or purpose. 319, my dear friends, persons likely to transfer property to avoid tax. 320, discontinued business. So these are the 5 cases where income of a tax year is to be taxed in the same tax year itself. So that's the story of the interesting points what we covered till now. Make sense, guys? Come on, let's proceed. So that's the story of section 316, 317, 318, 319 and 320. So what is that, my dear friends? What are the 5 points? So first point is what? Come on, let's repeat again. Shipping business of non-resident, person living India permanently or for long time, AOP, BOI, AJP formed for short duration or purpose, persons likely to transfer property to avoid tax, discontinued business. 316, 317, 318, 319 and 320. And what is section 211, my dear friends? ACCA. 277, person. 252, India. Section 3, tax year. Section 4, charge of income tax. Next point, my dear friends. Unexplained, undisclosed income. I'll talk about it slightly after some time. After 5-10 minutes, I'll talk about this. Next point. Heads of income. This is what is interesting. As I told you, section 13 talks about what are the various heads of income. Clear, friends? And what are various heads of income? Come on, friends. What are various heads of income? I told you that there are 5 heads of income. Income from salaries, income from house property, PGBP, profits and gains from business or profession, capital gains, income from other sources. And these are the various charging sections related to that heads of income. So, we have 5 different chapters in our syllabus. Salaries, house property, PGBP, capital gains, other sources. These 5 topics are given as 5 different chapters in our syllabus, which is important for us. And let me tell you very clearly, every topic will come in the examination. Whether it is salary or house property or PGBP or capital gains or other sources. Every topic will come in the exam. Marks are slightly more, slightly less, but every topic will come in the exam. And that's a part of our syllabus. So all 5 heads of income are a part of our syllabus. Next. Any non-exempt income not covered by first 4 heads automatically falls under income from other sources. That's why I told you that this is also called as residuary head of income. Because if there is an income which is not covered by first 4 heads of income, it is covered by income from other sources. Next line. GTI, gross total income, is the aggregate of income under 5 heads of income after clubbing. Example of clubbing, minor income is clubbed in the hands of parent and set off or carry forward of losses. If there is some loss, we will set off with income. If there is some loss, we will set off with what? Income. Exemptions given by section 11. There are certain incomes which are wholly or partly exempt. Exempt means what? Which are not taxable and they do not form part of total income at all. So they will never come as a part of total income. Next one, deductions. Something important. And deductions are given by chapter 8. Chapter 8 and dealt from section 122 to section 124 deals with the concept of deduction. Chapter 8. Now listen. Sir, there is something called deductions. When I say deductions, it is basically deductions from GTI. And of course, GTI stands for gross total income. And these deductions are given by chapter 8, my dear friends, which deals with the concept of deductions. I'll give a classic example. Let us say, for example, a person has earned income of 10 lakh rupees. Out of the 10 lakhs, 1 lakh rupees he paid towards life insurance premium. Then law is telling, don't pay income tax on 10 lakhs. Pay income tax only on 9 lakhs. Student is telling, wow, is it for everything, sir? How much, sir? Relax, relax, relax. There are different types of deduction for different purposes, specifically given in the law with some limits. And these deductions are based on two types, my dear friends. That is, deduction based on payment, deduction based on income. If it is deduction based on payment, it is reduced from gross total income. Example, life insurance premium given by section 123, medical insurance premium. So like this, there are multiple payments which are covered, which are allowed as deduction. And for all the deduction, for almost various deduction, there are some limits. There are very few deduction where there is no limit. And if it is deduction based on income, it is first included in gross total income and then deduction is allowed. Because this is clearly a deduction which is based on income. And I can give a classic example for this deduction based on income. For example, sir, royalty on books or royalty on patents. For this, there are some specific sections which gives deduction. So if it is based on income, we will first add and then claim deduction. Please see here. The deductions to be made in computing the total income are specified in chapter 8. They are of three kinds. Number 1, in respect of certain payments. Example, life insurance premium, PPF, which stands for Public Provident Fund. It's like a saving scheme. Medical insurance, section 123 onwards. In respect of certain income, example, royalty on patents, corporate societies, etc. Other deduction, example, person with a disability, 154 section, that also gives deduction from gross total income. So the difference between exemption and deduction is very clear. Exemptions are those which will not form part of total income. Deductions are those which are reduced from gross total income. Next one, total income. Total income is nothing but gross total income minus deductions under chapter 8. Also, the taxable income. Total income is also called taxable income. It is rounded off to nearest multiple of 10 rupees as per section 5 and 6. Section 5 and 6 talks about rounding off. Rounding off clearly says you round off to nearest multiple of 10. So the last number is 5 and above, we will take it to next 0. If it is less than 5, please take it to previous 0. So what we are trying to do is, we are taking incomes like this. Income from salary, house property, PGBP, capital gains, income from other sources. All 5 heads of income put together, what we get is called gross total income. And from that gross total income, we will take deductions under chapter 8. And once we reduce this deduction, what we get is called total income, or also called taxable income. On this total income or taxable income, my dear friends, total income or taxable income, on this total income or taxable income, we will compute the tax payable. That is the story, my dear friends. I'm sure we got very good clarity. If you are completely clear, I'll directly proceed to discussion about the concept of tax rates. Once I start tax rates, we'll do a lot of calculation. Take some good questions and please keep on solving what are the tax rates for various cases. Yes, my dear friends, we have understood very clearly the concept of basic provisions of income tax. Now it's time to talk about what are the interesting tax rates in our syllabus, which is important for us to understand how do we compute the tax, my dear students. So first of all, what is tax? Tax is a compulsory fee charged by government. And what are the two types of taxes? Direct taxes and indirect tax. Direct tax is a tax where impact and incidence is on same person. Indirect tax is the tax where impact and incidence is on different person. So person who is liable to pay, person who actually pays. Both are the same in case of direct tax. Both are different in case of indirect tax. And what are sections we have done till now? Come on, my dear friends. Please tell me, come on, what are sections we have done? We discussed what is India, defined by section 252. Defines what is India. India covers territory, territorial waters, seabed and subsoil underlying such water, continental shelf and exclusive economic zone and any other maritime zone, and also includes airspace above territory and territorial waters. So that is a concept what we covered there. Next, 211, 277. Both are interrelated because 211 talks about who is an assessee, 277 talks about who is a person. And I clearly told you one wonderful statement called every assessee is a person, but every person need not be an assessee. Correct or not? Person includes what? Individual, HUF, company, firm, LLP, AOP, BOI, AJP. All these are local authority. All these are covered in definition of person. Then 211 defines who is an assessee. Come on, who is an assessee? Assessee means any person who is liable to pay tax and includes every person in respect of whom proceedings have been taken up for assessment of his income or loss sustained by him or refund due to him or assessment of income of any other person in respect of which he is assessable or loss sustained by such other person or refund due to such other person. So these are the interesting points what we discussed there. Yes or no, my dear friends? Exactly. Come on. And we have also covered some interesting provisions related to what else? Section 3. What is section 3? Definition for tax year. Section 4, charge of income tax. Then we have also done 316, 317, 318, 319 and 320. These are the cases where income of a tax year is chargeable to tax in the tax year itself. What is 316? Come on friends, what is 316? Persons. Come on, 316 is what? Shipping business of non-resident. 317, persons living in India permanently or for long time. 318, AOP, BOI, AJP formed for short duration or purpose. 319, my dear friends, persons likely to transfer property to avoid tax. 320, my dear friends, discontinued business. In first four cases, AVO shall. That means mandatory. And in last case, it is AO may. Discretion is there with the assessing officer. That is what is the interesting points we have covered. Are we all clear till this stage, everybody? So that's the story of the concepts, what we have done till now. And picture is not yet done. We still have lot more interesting points to discuss here. Especially we have got to talk about tax rates. Are we ready? And before I proceed to tax rate, what are the 5 sources of income tax law? The 5 sources of income tax law are what? Come on. Income Tax Act 2025, Income Tax Rules 2026, Annual Finance Act, Circulars and Notification, Judicial Pronouncements. And the interesting point we also discussed is about section 13, which talks about heads of income. And under income tax, I clearly told you income is divided into 5 heads of income. Income from salaries, income from house property, PGBP, capital gains and income from other sources. Next, what else? These are all points we have covered. Yeah, 249 is also important section which talks about what is income. Definition for income. That's it. I think these are the sections what we discussed till now. Come on. Let me proceed to discussion about the concept of tax rates, my dear friends. And of course, we have also covered one more interesting section called section 5 and 6, which talks about rounding off. And it clearly says it is rounded off to nearest multiple of 10 rupees. What is rounded off? Income is rounded off to nearest multiple of 10 rupees. And when we combine all the 5 heads of income, what we get is called gross total income. From gross total income, we reduce deductions under chapter 8. Chapter 8. After reduce the deduction, what we get is called total income. On that total income only, we compute the tax payable. Come on, now listen. When I talk about tax rates, first let me talk about individual only. Okay, done. Individual or HUF or AOP or BOI or AJP. I am writing all this together because for partnership firm the tax rate is different, for companies the tax rate is different, corporate societies the tax rate is different, local authority the tax rate is different. That's why I am not covering it now, that will talk separately. So for individual, HUF, AOP, BOI, AJP. What they have given in the law is there is a concept known as default tax regime, other one called optional tax regime. And in default tax regime, my dear friends, default tax regime, tax rates are given in Income Tax Act only. I repeat one more time. In default tax regime, the tax rates are given in Income Tax Act only, whereas in optional tax regime, tax rates are given by Finance Act. So I repeat one more time, my dear friends. In case of default tax regime, the tax rates are given by Income Tax Act itself. And in optional tax regime, the tax rates are given by Finance Act. Sir, in default tax regime, the tax rates are given by Income Tax Act itself, and in optional tax regime, the tax rates are given in Finance Act. Now, what is the point to be noted here? Now, what is this default? What is this optional? In case of default, tax rates, other words, tax limits or rates are lower compared to optional. Come on friends, in default tax regime, the tax limits are lower when we compare with what, my dear friends? Optional. In default tax regime, the tax limits are lower as compared to optional, my dear friends. The moment I say that default tax regime, the tax rates are lower compared to optional, what our brain will start telling? If that is the case, then better go for default only. Why do you want optional at all? But there is a catch. Here comes the catch. That is, in default tax regime, various deductions or exemptions are not allowed. What are not allowed, that we'll talk separately. When we go there, we will talk in detail what are those exemptions or deductions which are not allowed. That we'll talk separately. When we go there, we will talk in detail what are the exemption deductions which are not allowed. But if you don't take these exemptions or deduction, then default tax regime is good. But if you want this exemption or deduction, then optional is good. Now student will start asking, sir, what is better then? What is better depends upon case specific. So that means you have an option to choose. Between default tax regime and optional tax regime. I'll discuss the tax rates and I'll also discuss the examples. Don't worry. Okay, my dear friends. So what are the two options a person has got? Individual HUF, AOP, BOI, AJP has got two options. Either they can go for a default tax regime or they can go for optional tax regime. Now student will get one more doubt in brain. Sir, is there a possibility that 1 year in default, next year in optional, 1 year in default, 1 year optional? Is it possible that switch in, switch out, switch in, switch out? Is it possible? Law told, yes, you can do that, provided you don't have business income. So I'll tell two situations here. Listen. No PGBP, there is PGBP. If there is no PGBP, sir, you can shift from default to optional, again optional to default, and again default to optional. This shifting is very much possible in case of what? No PGBP income. If you have PGBP income, sir, generally you are always in default. The name only says default, and you are telling, no, I don't want default, I will go for optional. Then you can withdraw from default, you can withdraw from default and go to optional next year. And you realize that optional is bad and you want to go back to default. Law told, no problem. You can again go back from optional to default. And henceforth, you cannot come back to optional. That means only one time switch out and switch in is allowed. Switch out means what? Switch out from default and go to optional. And again from optional, you can go back to default. And once you go back to default, you cannot come back to optional again. So the switch out and switch in is allowed only once. In case of what? If you have a PGBP income. If you don't have PGBP income, you can switch in, switch out, switch in, switch out year on year. So just to put a year here as a clarity, sir. So let us say tax year 26-27, you are in default. And tax year 27-28, you told, no, I don't want default, I want optional. And you have withdrawn from default. Is that okay? Very much okay. And tax year 28-29, you are telling, no, this year I don't have much of deductions, I will go back to default. Can you go back? Yes. And once you go back, next year 29-30, you cannot tell, again I will come back to optional. You have to continue in default only. So one time only switch out and switch in is allowed. After that you have to continue in default only, no other option. If you are having income under PGBP. And let us say you don't have income under PGBP, law is telling do whatever you like. 1 year default, 1 year optional, 1 year default, 1 year optional, all that options you have. Now what is difference between default and option in terms of tax rates? Let's understand that. First this is optional, but first let me talk about default. Let me scroll down. Default tax regime. Section 202. Section 202 talks about default tax regime. See that. The default tax regime says, what are the limits, my dear friends? Up to 4 lakhs nil, 4 lakhs to 8 lakhs 5%, 8 lakhs to 12 lakh 10%, 12 lakhs to 16 lakh 15%, 16 to 20 20%, 20 to 24 25%, above 24 30%. And if you carefully observe, at every stage it is 4 lakh increasing. 4 to 8, 8 to 12, 12 to 16, 16 to 20, 20 to 24, about 24. And if you observe rate, it is increasing by 5%. 5, 10, 15, 20, 25, 30. Easy to remember, very easy to remember, because at every stage 4 lakhs is increasing and tax rate at every stage 5% is increasing. But how do we compute that? That's an important point. So for example, let us say, sir, these tax rates are always known as slab rates. What do you call it? Slab rates. Because if you see, higher the income, higher is the rate of tax. And the first slab is known as basic exemption limit. I repeat one more time. First slab is known as what, sir? Basic exemption limit. Because if you carefully see there, up to 4 lakhs, it is nil. When up to 4 lakhs, it is nil, that means 4 lakhs is known as basic exemption limit. Because up to 4 lakhs, it is nil. Come on, see next line. Let us see. There is one person, Mr. X. His income is equal to 17 lakhs. We'll compute tax under default tax regime. Come on friends, how do we compute the tax? Please tell me. Up to 4 lakhs, it is nil. ₹4 lakh to 8 lakhs at the rate of 5%. 4 lakhs to 8 lakhs is how much, my dear friends? 5%. 4 lakhs to 8 lakhs, how much is the figure? 4 lakhs to 8 lakhs figure is how much? 4 lakhs. Sir, in 4 lakhs to 8 lakhs, how much is there? 4 lakhs is there. Into what percent? 5%. 4 lakh into 5% comes to 20,000. Next. 8 lakhs to 12 lakhs at the rate of 10%. When I say 8 lakhs to 12 lakhs 10%, it is technically on 4 lakhs 10%, which comes to 40,000. Clear friends? Next line. 12 lakhs to 16 lakhs at the rate of 15%. That means technically on 4 lakhs it is 15%, which comes to 60,000. Next. 16 lakhs to, what is the limit actually? Sir, if you see here, what is the limit? If you see here, what is the limit? 16 lakhs to 20 lakhs. But I will not write it as 16 lakhs to 20 lakhs. I will write it as 16 lakhs to 17 lakhs. Why like that? There is a logical reason, because 16 to 20 I will not write, because income is only 17 lakhs. When income is only 17 lakhs, why should I write 16 to 20? 16 to 20 lakhs, 16 to 17 lakhs at the rate of 20%. That means on 1 lakh, 16 to 17 lakhs is 1 lakh only, no? On 1 lakh, 20%, which comes to 20,000. And the total figure comes to 1,40,000. This concept is known as the concept of slab rates. The slab rate keeps increasing as income keeps increasing. If you tell a statement that 17 lakhs income, some students, the biggest blunder they understand, biggest blunder they do always is something like this. Sir, 16 to 20 lakhs, it is 20%. So on 17 lakhs, directly we will do 20%. 17 lakhs, directly if you do 20%, it comes to 3,40,000. And government doesn't want you to pay 3,40,000. Because this concept is known as slab rates. As the slab keeps increasing, the income keeps increasing, the tax also keeps increasing. That's where I told you a concept called progressive system of taxation. Higher income, higher tax, lower income, lower tax, which is not there in GST or indirect tax as such. It's there only in income tax. That's the beauty of income tax. Are we all getting clarity on this point? Excellent. Let me proceed. Get back. So what is the limits, my dear friends? Up to 4 lakhs nil, 4 to 8 5%, 8 to 12 10%, 12 to 16 how much percent? 15. 16 to 20 20%, 20 to 24 25%, about 24 lakhs 30%. So let me take one more example for students' benefit. Let us say there is Mr. X whose income is 30 lakhs. Compute tax under default tax regime. Come on friends. Mr. X income is 30 lakhs and the question is all about compute tax under default tax regime. Come on friends. How do I compute the tax? Up to 4 lakhs, nil. Up to 4 lakhs, nil. 4 lakhs to 8 lakhs at the rate of 5%, which comes to 20,000. 8 lakhs to 12 lakhs at the rate of 10%. That means on 4 lakhs 10%, which comes to 40,000. Next. 12 lakhs to 16 lakhs at the rate of 15%. On 4 lakh 15% comes to 60,000. 16 lakhs to 20 lakhs at the rate of 20%. On 4 lakhs, 20% comes to 80,000. Next. 20 lakhs to 24 lakhs at the rate of 25%. That means technically on 4 lakhs, 25%, which comes to 1 lakh. And greater than 24 lakhs at the rate of 30%. And can you please tell me what is the income here? Income is 30 lakhs. When income is 30 lakhs, greater than 24 lakhs, how much is the figure? 6 lakhs. On 6 lakhs, 30% comes to 1 lakh 80,000. And the total tax will work out to 4 lakhs 80,000. But on 30 lakhs, if you directly apply 30%, it comes to 9 lakhs. That's not the answer, because we have to follow the concept of slab rates. Friends, are we getting complete clarity on this point? Very, very interesting. And these are the tax rates given by default tax regime under section 202. Up to 4 lakhs, nil, 4 to 8, 5%, 8 to 12, 10%, 12 to 16, 15%, 16 to 20, 20%, 20 to 24, 25%, about 24, 30%. Next point. Opting out of default regime. And as I told, in default regime, you will not get a lot of deductions and exemptions. A person with business or profession income may opt out on or before the due date for return under section 263. It was once upon a time 139, but now it is 263 section. That means before filing return of income, you can exercise the option. And once exercised, it applies to subsequent years and may be withdrawn only once. That means only once there is an option of switch out and switch in. I told you very clearly. A person without business income. A person without business income may choose each year along with the return. That means every year he can choose whether he wants default or he wants optional. Next. On opting out, the total income is computed without specified exemptions or deductions. That means no deductions or exemptions are allowed once you come out of optional. And you can't take chapter AC deductions also. Except some employers' NPS, National Pension Scheme, Agnipath for army persons, new employment incentives. We'll talk about all these deductions in detail. Sir, what deductions will come? What deductions will not come? What exemptions will come? What exemptions will not come? We will talk in detail separately. But one thing is for sure, that is, lot of exemptions or deductions are not allowed in case of default tax regime. That point is clear, that lot of exemptions or deductions are not allowed in case of default tax regime. Make sense, right? Come on, see next. Faculty suggestion. My suggestion, please see. If question is silent, compute under both the default 202 and also optional regime and suggest the lower one. If question is telling, sir, in exam question, sometimes what they do is they will only tell compute tax payable, but they don't tell whether it is default or optional. So what I always advise is do both and tell which one is lower. And if it specifies a regime, if question only they tell under a default tax regime, or in question sometimes they will tell opted out of default, that means what? Optional. Follow that regime rates. Get back now. Let us see the optional tax rates. In optional tax rates, my dear friends, rates are given in Finance Act, and let me tell you, the rates are clearly based on age criteria, and we divide them into 3 categories: normal, senior, super senior. Normal means up to the age of 59. 60, exactly 60 also. 60 means his birthday is during that tax year. 60 to 79, we call it as senior citizen. 80 and above, we call it as super senior citizen. And the rates of tax are different in these 3 categories. See now. Individual below 60 years. Exact 60 also is not covered. Below 60, up to 59. HUF, AOP, BOI, AJP. And also non-resident individual irrespective of age. That means if there is an individual If there is an individual, he is a non-resident. Whatever is his age, be it 75 or be it 80, be it senior, super senior, he will still come under the first category only. And what are the slab rates? Please see. Up to 2,50,000 nil, 2,50,000 to 5 lakhs 5%, 5 to 5 lakh to 10 lakh 20%, above 10 lakhs 30%. And these rates are there since ages. Since past so many years, these limits are like that only. In default, the government has changed the limit, but they have not changed the limits in optional. Because in optional, you anyways get a lot of deductions and exemptions. And if you have that deductions, exemptions, then it's better to choose optional. If not, always choose default only. So what to choose depends upon how much exemption deductions you have. So up to 2,50,000, nil. 2.5 to 5 lakhs, 5%. 5 to 10, 20%. Above 10, 30%. Let's do some workings. Let's say, for example, one more example, guys. Let us say there is one person, Mr. X. Person, Mr. X. Age is 49 years. And income is 12 lakhs. When I say income, I am always refers to total income or taxable income, not gross total income. Because from gross total income, we reduce deductions. After deductions, only what we get is called total income. On total income only, we will compute what is the tax payable. So age is 49 years, income is 12 lakhs. Compute tax under optional. Other words, or shifted out of default. If it is shifted out of default or withdrawn from default, whatever language you use, English language boss, shifted out of default, withdrawn from default, still the answer is same. Come on, how do we compute the tax? The moment I say optional, I am concerned with age criteria. In default, there is no age criteria as such. Yeah, come on, what is the limits now? Up to 2,50,000 nil. So that is called basic exemption limit. 2,50,000 to 5 lakhs at the rate of 5%. That means on 2,50,000 it is 5%, which comes to 12,500. Next limit, next slab, 5 lakhs to 10 lakh at the rate of 20%. There is no 10%, 15% slab. There is no 10%, 15% slab. Directly 20%, guys. On 5 lakhs, 20% comes to 1 lakh. And above 10 lakhs, at the rate of 30%. About 10 lakhs, how much is the figure? Income is 12 lakhs, I told. So about 10 lakhs, the figure is how much? About 10 lakhs, the figure is 2 lakhs. On 2 lakh, 30% comes to 60,000. So total figure is 1,72,500. In exam, you can carry calculator. So don't worry. Don't look at me that way. Clear, guys? So wonderful. So these are the tax rates example in case of what? In case of optional tax regime. Now let me take one example where I'll compare both the default and optional. Okay? So that complete clarity will come. Listen. So let us say there is one person, Mr. X, whose age is 50 years. And let us say gross total income is 20 lakhs. Deductions or exemptions. Deductions or exemptions allowed under optional is equal to 4 lakhs. Deductions or exemptions allowed under optional is how much, my dear friends? 4 lakhs. Or let's say, for example, I'll take it as 3 lakhs. So that more clarity will come. Deductions, exemptions allowed under option is equal to 3 lakhs. Now my question will be, compute tax under default and optional. So one side, let me compute tax on default. Tell me guys, default regime, what is it we are going to do? Tell me, come on. Default regime, we will compute tax on 20 lakhs because that exemptions or deductions of 3 lakh rupees is allowed only in optional but not in default. Other side, I will write it as optional tax regime, wherein we will compute tax on 17 lakhs. Then we will decide which one is better for us. Clear, no friends? Just like that we can't tell default is good. Just like that we can't tell optional is good. The answer is it always depends. So if anybody is asking you, your friend or family or relatives or somebody, relatives, crazy people in our life, yeah? If they ask you which one is better, you should tell the answer, it depends. You give complete data to me, then I'll tell. That too I will charge fees for that. Nothing free of cost. Correct? No. Come on. So default tax regime will compute tax on 20 lakhs. So what is the working now? Come on, please tell me. Up to 4 lakhs nil. 4 lakh to 8 lakh 5%, which comes to 20,000. 8 lakhs to 12 lakhs 10%. That means on 4 lakhs 10%, which comes to 40,000. 12 lakhs to 16 lakh at the rate of 15%. That means on 4 lakh 15%, which comes to 60,000. And on 16 lakhs to 20 lakhs at the rate of 20%. 4 lakh 20% is 80,000. And the total tax is coming to 2 lakhs. Clear, friends? Other side, let me compute tax on optional now. Please see here. How do I compute tax here? Up to 2,50,000, it is nil. And 2,50,000 to 5 lakhs at the rate of 5%, which comes to 12,500. Next, 5 lakhs to 10 lakhs at the rate of 20%, which comes to 1 lakh. Because 5 lakh to 10 lakhs is 5 lakh. On 5 lakh, 20% comes to 1 lakh. Yes or no, my dear friends? Next, greater than 10 lakhs at the rate of 30%. How much is greater than 10 lakhs? Come on, friends, please tell me how much is greater than 10 lakhs. Greater than 10 lakhs is how much? 7 lakhs. On 7 lakh, 30% comes to 2 lakhs 10,000. So total figure is 3 lakhs 22,500. 3 lakhs 22,500. Now please tell me, what is better? Default tax regime is better. Understanding is, so by seeing this example, you should not directly tell, sir, a default is only better, always. You do not tell that word always, because it clearly depends upon what level of exemptions or deductions you have. Based on that only, we will decide which one is better. Clear? Understanding? So let me give one more extension to this question. That is, what would have been your answer if exemptions or deductions, under optional is, let us say, 5 lakhs. or let us say for example, exemptions or deductions is 7 lakhs. Okay guys, if it is 7 lakhs, we will compute tax only on 13 lakhs. Friends, please speak out. We will compute tax only on 13 lakhs. If it is on 13 lakhs, what will be the answer? Up to 2,50,000 nil, 2,50,000 to 5 lakhs at the rate of 5%, which comes to 12,500. And 5 lakhs to 10 lakhs at the rate of 20%. 5 to 10, 20% is how much? 1 lakh. And greater than 10 lakhs at the rate of 30%. That means on 3 lakh, 30%. 3 lakh, 30% is coming to 90,000. So how much will be the figure then? 2 lakhs, 2,500. So even when there is a deduction of 7 lakhs, still the answer is 2 lakh, 2,500. Still default is only better. I am sure we are getting very good clarity on this point. So it is important for the student to understand very clearly that lot of circumstances, generally I will tell majority cases, I would tell like this, majority cases default tax regime is only better. But if you have got lot of exemptions or deductions, what are those exemptions, deductions? We will talk in detail separately. But if you have got lot of exemptions or deductions, in that case, always optional is better. Got it, my dear friends? So this way we need to compute. Get back now. So in optional, I told you that there are 3 categories: normal, senior, super senior. Normal, what are the slab rates? Up to 2.5 lakhs, nil, 2,50,000 to 5 lakhs, 5%, 5 to 10, 20%, about 10, 30%. Next one, resident senior citizen. That word is important, resident, because non-resident is covered in first category only. Everything is same with a small difference. Up to 3 lakhs, it is nil. What was there previously? Up to 2.5 lakhs nil. Here it is up to 3 lakhs nil. Rest of the story is same. 3 to 5, 5%, 5 to 10, 20%, about 10, 30%. Next, resident super senior citizen. What is that? Resident super senior citizen. Up to 5 lakhs, it is nil. 5 to 10, 20%, about 10, 30%. So if you observe, the only difference is in normal up to 2.5 lakhs nil, senior up to 3 lakhs nil, super senior up to 5 lakhs nil. Senior means 60 to 79 years. Super senior means 80 and above. That is that age gap what you have to observe. So the difference between the slabs with respect to normal, senior, super senior is normal up to 2.5 lakhs nil, senior up to 3 lakhs nil, super senior up to 5 lakhs nil. Rest of the story is the same. I am sure we are getting very good clarity on this point. Everyone please reply. Wonderful, my dear friends. So to summarize the whole story what we discussed till now, tax rates for individual, HUF, AOP, BOI, AJP. And for partnership firms, companies, it is separate, which we will talk in detail separately. So for individual, HUF, AOP, BOI, AJP, my dear friends, default tax regime, optional tax regime. Default, section 202. Optional, the rates are given by Finance Act. And in default tax regime, what is the answer? Come on, please tell me. Up to 4 lakhs, nil. 4 lakhs to 8 lakhs, 5%. 8 lakh to 12 lakh, 10%. 12 lakh to 16 lakhs, 15%. 16 lakhs to 20 lakh, 20%. 20 lakhs to 24 lakhs, 25%. About 24 lakhs, 30%. Next, in optional, come on friends, in optional, again there are three interesting categories. The three interesting categories are normal, senior, super senior. Normal 0 to 59, senior 60 to 79, super senior 80 plus. 80 plus up to jab tak hai jaan. Come on, normal, what is the story? Up to 2.5 lakhs nil, 2.5 lakhs to 5 lakh at the rate of 5%, 5 lakh to 10 lakh 20%, greater than 10 lakhs 30%. Senior up to 3 lakhs nil, 3 lakh to 5 lakh 5%, 5 lakh to 10 lakh 20%, above 10 lakhs 30%. And the last one, my dear friends, super senior category, up to 5 lakhs it is nil, and 5 lakhs to 10 lakh it is 20%, greater than 10 lakhs it is 30%. So that is the story of the tax rates for individual, HUF, AOP, BOI, AJP, where you have got default tax regime and optional tax regime. And default tax regime, various exemptions or deductions are not allowed. And in optional, all exemption deductions are allowed. And which one to choose? It depends. Based on exemption deductions, what you have got. Are you getting complete clarity on this point, my dear friends? Now, apart from this, some special point I will tell you is that there is something called surcharge. What do you call it, my dear friends? Surcharge. This surcharge is basically levied for high income persons. As I told already, in India, we follow progressive system. So law told, if you have high income, you please pay high percentage of tax. There is something called surcharge, 10%, 15%, 20%, 25%, 37%. We'll talk in detail. Apart from surcharge, there is also something called health and education cess at the rate of 4% of tax payable. When I say tax payable, the normal tax what we computed plus surcharge. On the total tax payable will compute 4%. And this is mandatory. It is not optional. Sir, the word used, if you see, health and education cess, the word used is not health and education tax. The word cess is used whenever government collects some extra tax, whenever government collects some extra tax for a specific purpose. Whenever government collects extra tax for a specific purpose, they don't call it as tax, they call it as cess. This extra cess of 4% is being collected by the government for the purpose of health and education. That is why it is known as health and education cess, my dear friends. It is not called health and education tax. It is known as health and education cess because extra amount is being collected for the purpose of health and education. Come on, see here. Let me give a small example with total tax computation. Let us say one person, Mr. X, his income is 15 lakhs. Please compute tax under default tax regime. Come on, friends, how do we compute the tax? Come on, please tell me. Up to 4 lakhs, the tax will be nil. And 4 lakhs to 8 lakhs at the rate of 5%, which comes to 20,000. 8 lakhs to 12 lakhs at the rate of 10%, which comes to 4 lakhs 10%, which comes to 40,000. Up to 4 lakhs nil, 4 to 8 5%, 8 to 12 10%. Next, 12 lakhs to 16 lakhs normally. 12 to 16 is 15%, but I will take it as 12 lakhs to 15 lakhs at the rate of 15%. On 3 lakh 15% comes to 45,000. Clear? And the total tax will come to how much, my dear friends? 20, 40, 60, 1 lakh 5,000. And to this we will add health and education cess, which is known as HEC, at the rate of 4%. 4% on 1 lakh 5,000. On 1 lakh 4% is how much? 4,000. On 5,000 4% is 60. It comes to 4060 or 600. Wait a second. 1 lakh 5,000 into 4%. 1 lakh 4% is 4,000. On 5,000 4% will be 5,000 4% will be 60 only. Exactly. So it will be 4060. Total will be 1 lakh 9,060. This is the total tax payable including HEC, health and education cess, at the rate of 4%. Very, very interesting point. I am sure we got complete clarity till this stage of default tax regime and optional tax regime. Come on, please reply, my dear friends, everybody. Very, very good. See one important point. Age on 1st April. A person born on 1st April is treated as attaining that age on 31st March. That is preceding day itself. So a resident whose 60th birthday or 80th birthday falls on 1st April is treated as senior or super senior in the previous tax year only. Very, very interesting point. Understanding, my dear friends? Everybody, are we clear? Wonderful. Let's proceed. So my dear students, we have got clarity in terms of what is the difference between default tax regime and optional tax regime, and which one is better is always dependent upon case to case scenario based on exemptions or deductions which are available to that particular person. Based on that only we are going to decide which one is better. We cannot just like that tell this is good or that is good. So what is good clearly depends. Make sense, right, everybody? Excellent. Let me move forward now. Now, friends, let me tell you one more interesting aspect here. We will talk about some interesting concept which is very important and a high probability that a point may trigger in the examination. That is known as concept of rebate. Rebate under section 156. Rebate under which section, my dear friends? Rebate under section 156. This is called rebate. Rebate is like a discount or a benefit given. This rebate, okay, first of all, let me write like this. This rebate is allowed only and only to a resident individual. It is not allowed to any other person. It is allowed only to a individual, that too to a resident. If a non-resident will not give this. And I already told, to decide whether a person is resident or non-resident, it clearly depends on a concept called duration of stay in India. How long the person has stayed in India? Based on that we are going to decide whether he is a resident or is a non-resident. Next topic after this basic concept we are going to talk is residential status only. There I'll talk with you in detail. When do we treat a person as a resident? When do we treat a person as non-resident? I'll discuss with you in detail when I go there. Don't worry. Make sense, right? Come on. So this concept of rebate under section 156 is for a resident individual only. It is not for any other person. Now listen, one more point. Default tax regime. Other side, optional tax regime. You will find some beautiful points now. Listen, in case of default tax regime, rebate is allowed only to resident individual, of course, only to those whose total income does not exceed 12 lakh rupees. Less than or equal to how much, sir? 12 lakh rupees. When I say total income, total income always means gross total income minus deductions. And what is gross total income? 5 heads of income combined together, what we get is called gross total income. From gross total income, we reduce the deductions. From gross total income, we reduce the deductions. Then only we get something called total income. And on that total income, we will compute the tax payable. And if total income does not exceed 12 lakhs, then only we get rebate. And rebate is equal to tax payable or 60,000, whichever is lower. Rebate is how much, sir? Tax payable or 60,000, whichever is lower. And optional tax regime, rebate is allowed only for those whose total income does not exceed 5 lakh rupees. And here, rebate is equal to tax payable or 12,500, whichever is lower. Let me discuss something very interesting concept now with examples. Let me discuss this concept with example so that complete clarity will come. Listen now. Let us say there is one person, Mr. X, whose age is 45 and total income is 10 lakhs and he is under default tax regime. Come on, what is going to happen? Come on, Mr. X, age 45, total income is 10 lakhs and that too is under default tax regime. What is default tax regime? Tax rates, my dear friends, come on, please tell me. Up to 4 lakhs is equal to nil. And 4 lakhs to 8 lakhs at the rate of 5%, which comes to 20,000. Next slab is what? 8 lakhs to 12 lakhs. But I'll write it as 8 lakhs to 10 lakhs at the rate of 10%. 8 lakhs to 10 lakhs, how much is the value? 8 lakhs to 10 lakhs, the value is only 2 lakhs. And on 2 lakh, 10% comes to 20,000. Total figure is 40,000. And I'll claim something called rebate under section 156. Why rebate is coming? Because Mr. X is a resident individual and his total income is not more than 12 lakhs. He can claim something called rebate. And rebate is how much? Tax payable or 60,000, whichever is lower. And let me write one important point. This rebate is to be claimed always before HEC. You should not add HEC and then take rebate. HEC means what? Health and Education cess. You should not add HEC and take rebate. You should always take the rebate before HEC only. And what is the rebate under section 156? Rebate under section 156 will be 40,000. And tax payable will be nil, my dear friends. Crazy point. So let us say one more example here. One more example. Total income is 12 lakhs and that too under default. Mr. A, who is a resident. Tell me guys, what is going to happen? Up to 4 lakhs, it is going to be nil. 4 lakhs to 8 lakhs at the rate of 5%, which comes to 20,000. 8 lakhs to 12 lakhs at the rate of 10%, which comes to 40,000, and total is 60,000. Now tell me my dear friends, by seeing the question, what is the total income? Total income is 12 lakhs. Please tell me, when total income is 12 lakhs, can I take rebate? Answer is 100% yes, because rebate is allowed if total income does not exceed 12 lakh rupees. If total income does not exceed 12 lakhs, then 100% rebate is allowed. And what is the rebate? Rebate will be tax payable or 60,000. Tax payable or 60,000, whichever is lower, which is again 60,000. And net effect, the tax payable is nil. Now I'll tell one dialogue and I'll tell one statement, which is actually very true. The dialogue and statement which I'll tell is, if any individual is there, he is a resident. If any individual is there, he is a resident. If total income is not more than 12 lakh rupees, then the tax is straight away zero. The tax is straight away zero. So if there is a resident individual whose total income is not more than 12 lakh rupees, his tax will be zero because of rebate. Because of what's sir? Rebate. Now let us say, for example, one more example I'll give. Total income is 13 lakhs. Mr. A, that to a resident. What will happen? Technically no rebate. Correct, no friends? Up to 4 lakhs nil. 4 lakh to 8 lakh 5%, which comes to 20,000. 8 lakhs to 12 lakh 10%, which comes to 40,000. And 12 lakhs to 13 lakhs 15%. 1 lakh 15% is 15,000. And the total figure is how much? 40 plus 20, 60 plus 15, 75,000. And straight answer, no rebate. Why no rebate? For a simple reason, because total income is more than 12 lakh rupees. Rebate will come only when total income does not exceed 12 lakhs. If not, rebate will not come. Clear, my dear friends? Very interesting point. Now I'll tell you one crazy situation here. You will enjoy this. Let us say there is one person, Mr. X, who is a resident, and income is 12 lakh 50,000. So tell me, if income would have been 12 lakhs, if income would have been 12 lakhs, I repeat, if income would have been 12 lakhs, what would have been the tax? 100% tax would have been zero because of rebate. But here what is happening here? Same thing I'll write here. Up to 4 lakhs nil, 4 lakhs to 8 lakhs at the rate of 5%, which comes to 20,000. 8 lakhs to 12 lakhs at the rate of 10%, which comes to 40,000. And 12 lakhs to 12 lakh 50,000 at the rate of 15%. And on 50,000, 15% comes to 7,500. Total is 67,500. Please tell me, sir, I'll ask you one basic question. Please answer. Sir, if his income would have been exactly 12 lakhs, if his income would have been exactly 12 lakhs, what would have been the tax? Zero. How much is extra earned beyond 12 lakhs? Beyond 12 lakhs, extra earned is 50,000. Now tell me, just because he has earned 50,000 more, will you ask him to pay 67,500, sir? Ridiculous. You are asking him to pay more than extra what he earned. So law is telling, don't worry, don't cry. Don't cry. We will give you rebate under section 87A. In this case also, that rebate will be extra tax beyond income. What is the extra tax beyond income? 17,500 and you silently pay 50,000 as tax. That means how much extra you earned, you pay. Because why you are crying? Please tell me why you are crying. You are crying because your extra tax is coming more than income. Your tax, extra tax is how much? 0 minus 67,500. 67,500 I'm asking you to pay because you earn 50,000. You are crying because you are paying more than your income, right? Then pay 50,000 to me silently. Over. Discussion between you and me is done. Friends, understanding? So that is the story of a concept of rebate in case of resident individuals. Very, very important. And in case of default tax regime, rebate is allowed if total income does not exceed 12 lakhs and rebate will be tax payable or 60,000, whichever is lower. And in case of optional tax regime, rebate will be tax payable or 12,500, whichever is lower. And there it is allowed only if it does not exceed 5 lakh rupees. So for example, let us say, one example for optional also let me give. Mr. X, age 35. Total income is, let us say, 4 lakhs. And he is a resident individual. That too he is under optional. Please tell me guys, what will you do? Up to 2,50,000 nil. 2,50,000 to 5 lakhs, 5%, right? But I'll take it as 2,50,000 to 4 lakhs. At the rate of 5%. On 1,50,000, 5% will come to 7,500. Total is 7,500 less rebate under section 156, 7,500 and net tax payable will be nil. That is the story of the concept of rebates. Given by which section, my dear friends? 156. Resident individual under optional regime, rebate is up to 12,500 if total income does not exceed 5 lakh rupees. Resident individual under default tax regime, rebate up to 60,000 if total income does not exceed 12 lakh rupees. The rebate equals income tax payable or the cap, whichever is lower. That means rebate is always tax payable or that 60,000, whichever is lower. If it is optional, tax payable or 12,500, whichever is lower. And rebate is always to be claimed before HEC. So that is the story of the concept of rebate under section 156. Clear? Wonderful. Let's proceed. So my dear friends, we have clearly discussed the concept of the rebate under which section, my dear friends? Section 156. And this benefit of rebate is allowed only for whom? Only for resident individuals, and total income limit and rebate limit is clearly based on whether it is default tax regime or optional tax regime. If it is default tax regime, what is the concept of rebate? Rebate is allowed to resident individual whose total income does not exceed 12 lakh rupees and the amount of rebate is tax payable or 60,000, whichever is lower. And other side of the story, in case of optional tax regime, rebate is allowed to a resident individual whose total income does not exceed 5 lakh rupees. And the amount of rebate is tax payable or 12,500, whichever is lower. So that is a concept of rebate with respect to section 156, which is allowed only to a resident individual. Friends, now that we are done with discussion about the concept of default tax regime and optional tax regime in case of individual HUF, AOP, BOI, AJP, now let me also tell you something interesting which we have already done, that is about the concept of health and education cess at the rate of 4%. And that is on the tax. We have discussed that as well. Now, moving forward, we are done with rebate. Then HEC we have discussed. What is HEC percentage? HEC percentage is always 4% on tax plus surcharge. Now, what is that surcharge is what I want to spend some good time now. Sir, we are done with tax rates for individual HUF, AOP, BOI, AJP. Before I talk about firms, LLPs and companies, let me spend some good time on discussion about completion of concept of tax on individuals. That is related to surcharge. Let me complete so that that aspect will be over. See here. Surcharge. Now first of all, what is surcharge? I already told surcharge is nothing but an additional tax for high income persons. Surcharge is nothing but additional tax for high income persons. Now what is that high income? We'll talk in detail, don't worry. And always I told you, higher the income, higher the tax, lower the income, lower the tax. That's quite obvious. See here. Individual HUF, AOP, BOI, AJP. Total income. And other side we have optional or it is default. And default section number we know, default section 202. What are the tax rates in default? Up to 4 lakhs, 4 to 8, 8 to 12, 12 to 16, 16 to 20, 20 to 24, about 24 lakhs. And the rates of tax are nil, 5, 10, 15, 20, 25 and 30%. Already we have done that. And in optional, we have discussed that the rates of tax are based on the age criteria. Normal, senior, super senior. Normal is below 50 years, senior is 60 to 79, super senior is 80 and above. And the limits are what? Normal, 2.5 lakhs nil, 2.5 to 5, 5%, 5 to 10, 20%, about 10, 30%. Senior, what is the story? Up to 3 lakhs nil, 3 to 5, how much? 5%, 5 to 10, 20%, about 10, 30%. And super senior, up to 5 lakhs nil, 5 to 10, 20%, about 10, 30%. That is a concept which is important. And we have discussed that very clearly. Make sense, right, everybody? Exactly. Come on, let's move forward. What is the rates of surcharge? Let's talk about what are the rates of surcharge. Total income more than 50 lakhs and it is up to 1 crore. Then the rate of surcharge is 10%, whether it is optional or it is default. More than 1 crore to 2 crores, it is 15%. 2 crores to 5 crores, it is 25%. So in first 3 cases, whether it is optional or it is default, the rates of surcharge are same. And as very important point is always, surcharge is a percentage on tax. Surcharge is never a percentage on income. Surcharge is always a percentage on tax. More than 5 crores. What is more than 5 crores? Total income. And whenever I say total income refers to taxable income. More than 5 crores, if it is optional, then it is 37% is the surcharge rate. If it is default, then surcharge rate is 25% only. And common sense point, in optional it is more because in optional we get lot of deductions and exemptions. And I already told the statement very clearly, whether to go for a default or to go for optional, it depends upon case specific. We cannot bluntly tell the answer, this is better or that is better. Make sense, right? Exactly. Come on. Let me take one interesting example here. Let us say, for example, there is one person, Mr. A, whose total income is 60 lakhs. Compute tax payable under default. Compute tax payable under what, my dear friends? Default tax regime. Come on, friends. How is that I'm going to compute the tax under default tax regime? Please tell me. Up to 4 lakhs, nil. $4 lakhs to 8 lakhs at the rate of 5%, which comes to 20,000. 8 lakhs to 12 lakhs at the rate of 10%, which comes to 40,000. 12 lakhs to 16 lakhs at the rate of 15%, which is 60,000. 16 lakhs to 20 lakhs at the rate of 20%, which comes to 80,000. 20 lakhs to 24 lakhs at the rate of 25%, which comes to 1 lakh. Greater than 24 lakhs, greater than 24 lakhs at the rate of 30%. Greater than 24 lakhs, 30%. And what is my total income? My total income is 60 lakhs. My total income is 60 lakhs. From that I'll reduce 24 lakhs because on that tax is already computed. Balance figure is 36 lakhs. On 36 lakh, 30% is coming to 10 lakhs 80,000. And what is the total figure, my dear friends? 20,000 plus 40,000 plus 60,000 plus 80,000 plus 1 lakh plus 10 lakh 80,000. Total is coming to 13 lakhs 80,000. It is the total tax. But the story does not end here. To this, I will add something called surcharge. Now, why did surcharge come into picture? Surcharge has come into picture because total income is more than 50 lakhs. And if it is more than 50 lakhs, not more than 1 crore, it is 10%. More than 1 crore, not more than 2 crores, 15%. More than 2 crores, not more than 5 crores, 25%. More than 5 crores, if it is optional, it is 37%. If it is default, it is 25%. That's what we discussed very clearly. So basically, government wants a person earning higher income to pay higher percentage of tax. Progressive system of taxation. So surcharge at what rate, my dear friends? Surcharge at the rate of 10%. And I already told surcharge is always a percentage on tax. So 13 lakh 80,000 plus 1 lakh 38,000. Total is coming to 15 lakhs 18,000. And story is not over yet. I will also add HEC at the rate of 4%. And HEC is always considered on what, my dear friends? Tax plus surcharge, which is coming to 60,720. So 15 lakhs 18,000 plus 60,720, it is coming to 15 lakhs 78,720. This is my total tax payable. I'm sure we are getting very good clarity on this point, my dear students. So friends, I'll give a small tip here, that is surcharge is a percentage on tax. HEC is a percentage on tax plus surcharge. So when surcharge is applicable, first always compute surcharge on the tax. Then take total of tax plus surcharge. On the total, you please charge HEC. That is a point to be noted. Because surcharge is always a percentage on tax, HEC is a percentage on tax plus surcharge. And HEC rate is always fixed, which is 4%. That means HEC will always come. Surcharge will come only when income is more than 50 lakhs. 50 lakhs to 1 crore, 10%, 1 to 2 crores, 15%, 2 crores to 5 crores, 25%, above 5 crores, optional 37%, and default 25%. Now I'll tell some special concept. Listen very clearly. Listen guys, please, you'll enjoy. Sir, listen guys, please, you'll enjoy. Sir, let's say for example, there is one person, Mr. A, whose total income is 50 lakhs. How much is the figure? 50 lakhs. My question to you. Will surcharge apply? 100% answer is no. Because surcharge will come into picture only when total income is more than 50 lakhs for individuals, HUF, AOP, BOI, AJP. But on 50 lakhs, please tell me what will be the tax computation, guys? Up to 4 lakhs, nil. 4 lakh to 8 lakh, 5%, which comes to 20,000. 8 lakhs to 12 lakh, 10%, which comes to 40,000. 12 lakh to 16 lakh, 15%, which comes to 60,000. 16 lakhs to 20 lakh at the rate of 20%, which comes to 80,000. 20 lakhs to 24 lakh at the rate of 25%, which comes to how much, my dear friends? Come on, 1 lakh. And greater than 24 lakhs at the rate of 30%. How much is greater than 24 lakhs, which is nothing but 26 lakhs into 30%, which is coming to 7 lakhs 80,000. Friends, understanding? So total figure is coming to 10 lakhs 80,000. That is my tax. And will surcharge apply? 100% answer is no. But to that we'll add HEC at the rate of 4%. 10 lakh 80,000 into 4%, which is coming to 43,200. And total figure will be 11 lakhs 23,200. That is the story of this interesting point. But why did I start this discussion? There is one strong reason why. Okay, listen. There is one person, Mr. B. This gentleman's total income is 51 lakhs. How much is the figure? 51 lakhs. And the question to you is, will surcharge apply? Come on, friends, will surcharge apply? 100% answer is yes. Because if it is more than 50 lakhs, surcharge will come into picture. Come on, friends, how am I going to compute the tax? Up to 4 lakhs, nil. 4 lakhs to 8 lakhs, 5%, which comes to 20,000. 8 lakhs to 12 lakh, 10%, which comes to 40,000. 12 lakhs to 16 lakh, 15%, which comes to 60,000. 16 lakh to 20 lakh, 20%, which comes to 80,000. 20 lakhs to 24 lakhs at 25%, which comes to 1 lakh. And above 24 lakhs at the rate of 30%. About 24 lakhs is how much? Come on. 27 lakhs into 30%, which comes to 8 lakhs 10,000. And total will be 11 lakhs 10,000. To that I will add surcharge. Correct, no friends? Surcharge at the rate of 10%, which is 1 lakh 11,000. So 11 lakhs 10,000 plus 1 lakh 11,000, which comes to 12 lakhs 21,000. So my tax payable is 12 lakhs 21,000. Now I'll ask you one question. Think very carefully and answer. If income would have been 50 lakhs, then tax is 10 lakhs 80,000. Yes or no, friends? The basic tax I am talking. The basic tax I am talking, not after HEC, because I am teaching some important concept here. Listen. So if income would have been 50 lakhs, tax is 10 lakh 80,000. But see here, if income is 51 lakhs, then tax is 12 lakhs 21,000. Can you please tell me what is the extra income, my dear friends? Extra income is nothing but 1 lakh. Because we are comparing with the limit of surcharge. The extra income is 1 lakh. And what is the extra tax that has come into picture? 12 lakh 21,000 minus 10 lakh 80,000, which is coming to 1 lakh 41,000. So if you observe carefully, extra income what I earned is 1 lakh. Extra income what I earned is 1 lakh. 1 lakh I earned extra, but government is asking me to pay extra tax of 1 lakh 41,000. Is it making sense, sir? Absolutely not making sense. Absolutely not making sense. My tax cannot be more than my income. Just because I earned 1 lakh more beyond the limit of surcharge, will you tax me 1,41,000? How is it justified? So government told, don't worry, don't cry, relax, relax, relax. We'll give you some interesting benefit. Listen, what they told the law is, if extra tax is more than extra income due to surcharge. If extra tax is more than extra income due to what, sir? Surcharge. Then marginal relief is allowed. What is allowed, my dear friends? Marginal relief is allowed. And the marginal relief will be equal to extra tax minus extra income. How much is marginal relief, my dear friends? Extra tax minus extra income. So from 12,21,000, I will reduce marginal relief. How much is marginal relief? 41,000. And total is coming to 11,80,000. So technically, if you observe, it was 1080, now it became 1180. So indirectly, what is happening is extra 1 lakh what you earned. Indirectly, what is happening is extra 1 lakh what you earned, you are paying entire 1 lakh as tax to government. Because you are crying, no. Why you are crying? You are crying because your extra tax is more than extra income. You don't want to pay tax more than your income. So government is telling, don't worry, don't cry. We will give you marginal relief. How much is marginal relief? Extra tax minus extra income. That entire 1 lakh you pay to us, need not pay 141. Nice. And to that, I will add HEC at the rate of 4%, which is coming to 47,200. That's it. That is the story of this interesting concept called marginal relief as well, my dear friends. And this is the concept of the surcharge in case of individual, HUF, AOP, BOI, AJP. Are we getting clarity, my dear friends? Everyone, sir. Very interesting concept. But one special point, please see below. Surcharge on tax on dividend income, and on income under 196, 197, 188, which talks about capital gains. In case of dividend income and in case of capital gain income, surcharge is capped at 15%. That means 25%, 37% will not apply in case of tax on dividend and in case of tax on capital gains. Will apply maximum 15%. And marginal relief ensures the rise in tax with surcharge does not exceed the rise in income beyond the threshold. That is, in simple terms, extra tax is not more than extra income. So that is the story of concept of tax rates in case of individual, HUF, AOP, BOI and AJP. Very, very interesting concept. Let me talk about other persons. How do we compute the tax? See here. For firms, LLPs, local authority. LLP means what? Limited liability partnership. For firm, LLP, local authority, the tax rate is pretty simple. Straight away, 30%. No discussion. No slab rates. Slab rate concept is for individuals only. And of course, we have for cooperative society, which we'll talk separately. So for firm, LLP, local authority, tax rate is what? Flat 30%. But one special point, that is, for firm, LLP, local authority, surcharge, if total income is more than 1 crore, surcharge is 12%. So for example, let us say there is a partnership firm whose total income is 2 crore. Total income always means taxable income, profit, not turnover. Profit is 2 crores. How do we compute the tax? Straight away 30%, which comes to 60 lakhs. and to that I will add surcharge at the rate of 12%, and 12% surcharge is always on the tax, which is 7,20,000. Total figure 67,20,000. To that I will also add HEC at the rate of 4%. 67,20,000 into 4% is coming to 2,68,800. 67,20,000 plus 268,800. Total is coming to 69 lakhs 88,800. That is the total tax payable. Clear? I am sure we got very good clarity. It's very simple. Compared to individual HUF and all, this is quite simple. So for firm, LLP, local authority, the tax rate is 30%, and surcharge will come when total income is more than 1 crore. And the rate of surcharge is what? 12%. Get back, next point. Cooperative societies. What is the tax rate? Up to 10,000, 10%. That means there is no basic exemption limit. Straight away there is 10% tax rate. Up to 10,000, 10%, 10,000, 20,000, 20%, above 20,000, 30%. Quite simple. Up to 10,000, 10%, 10,000, 20,000, 20%, above 20,000, straight 30%. Figures are correct only. Don't think zero is missing. It is correct. Surcharge for corporate societies. Please see that 1 crore to 10 crores 7%, more than 10 crores 12%. 1 crore to 10 crores 7%, more than 10 crores 12%. That is a story of tax rates for cooperative societies. So if you observe carefully, my dear friends, we are done with discussion about the concept of tax rates for individual, HUF, AOP, BOI, AJP, and also for firms, LLPs, local authority. We have also discussed the tax rate for cooperative societies. We are only left with discussion about the tax rates for companies. See now, companies, sir, Indian company generally 30%. However, if turnover during the year 24-25 does not exceed 400 crores, then the tax rate is 25%. And for foreign company it is 35%, my dear friends. And for new manufacturing domestic companies opting for section 201, that is a case where we will not get deductions, you will not get exemptions. But they told pay tax at 15%, mandatory surcharge 10%. And for domestic company opting section 200, here also there is a concept called no deductions or exemptions. Lot of exemption deductions are not allowed, but instead of paying 25%, 30%, you can pay 22% tax and a mandatory surcharge of 10%. So friends, simple nutshell summary of the story is what? Let me present to you very simple manner. Tax rates for company, domestic company, foreign company. In case of domestic company, generally 30%. But if turnover during 24-25 does not exceed 400 crores, then it is 25%. And there are two special points. New manufacturing company 15%, and for normal domestic companies it is 22%, but plus 10% surcharge, plus 10% surcharge. It is not 22 plus 10, 32. That 10% surcharge is on the tax. Surcharge is never a percentage on income. Surcharge is always a percentage on tax, my dear friends. Please don't do that mistake. And for foreign company, the tax rate is 35%. So what are the rates of surcharge, my dear friends? For a domestic company, more than 1 crore, not more than 10 crores, 7%. More than 10 crores, 12%. And for foreign company, since already the tax rate is 35%, they kept surcharge slightly lower, where they told 1 crore to 10 crores it is 2%, more than 10 crores it is 5%. So friends, let's discuss 1-2 examples. ABC Private Limited, total income is 6 crore and their turnover during 24-25 is 200 crores. So 400 crores is such a big number. So what will happen is tax will come at what rate, my dear friends? Tax will come at the rate of 25%, which is coming to what? 6 crore 25%, which is coming to 1 crore 50 lakhs. To that, we'll also add surcharge at the rate of 7%. Why 7%? Obviously for a simple reason, because more than 1 crore, not more than 10 crores, 7%, more than 10 crores, 12%. So surcharge at 7% comes to 10 lakh 50,000. Total figure 1 crore 60 lakhs 50,000. And I will add HEC at the rate of 4%. 1 crore 60 lakh 50,000 into 4%, which is coming to 6 lakhs 42,000. Total figure is 1 crore 66 lakhs 92,000. That is my total tax payable. Understanding, friends? But other side, let us say you opted for section 200. Correct only, no? Sir, see here. If you go for section 200 option, correct, no friends, where deductions, exemptions are not allowed. If you go for opted for section 200, then tax will be 22%, which comes to 1 crore 32 lakhs. And there will be mandatory surcharge at the rate of 10%. And the surcharge is mandatory, my dear friends. No option at all. The surcharge of 10% is mandatory if you go for section 200. So total is 1 crore 45 lakhs 20,000. And 1 crore 45 lakhs 20,000 into 4%, which is coming to 5 lakhs 80,800. So total comes to 145 20,000 plus 5 lakh 80,800 is coming to 1 crore 51 lakhs 800. That is the tax payable under option of section 200, wherein the tax rate is 22% and there is a mandatory surcharge of 10%. If not, normally it is what? 30%. But if turnover during 24-25 does not exceed 400 crores, it is 25%. And what are the rates of surcharge for domestic company? If it is more than 1 crore, not more than 10 crores, 7%. More than 10 crores, 12%. Foreign company, more than 1 crore, not more than 10 crores, 2%. More than 10 crores, how much is the rate? 5%. So that is the story of surcharge in case of Indian companies and foreign companies. Clear, everybody? Get back. So we are done with discussion about the concept of surcharge. You can see below computation of total income and tax liability. We all know that we'll aggregate all the 5 heads of income. Then what we get is called gross total income. From that we will reduce deductions under chapter 8. Balance what we get is called total income. And on total income we will compute the tax. If applicable, we will take a rebate under which section? Section 156. And we will add HEC. And we will also add surcharge if applicable. I will write here. Total tax liability. From that we will reduce TDS, TCS, advance tax, and balance whatever is there. That is called net tax liability, which is rounded off to nearest multiple of 10 rupees. Friends, are we all getting clarity on this point, everybody? Please reply. All of us. Done. Let's proceed. Friends, so we have clearly discussed in terms of what are the general tax rates, and whatever tax rates I discussed now with you are basically given by Finance Act. So what are the tax rates, my dear friend? To summarize the whole story, what we have done, we have one set of category for individual, HUF, AOP, BOI, AJP. Another set we discussed very clearly for firm, LLP, local authority. One point we discussed for cooperative societies. Then we spoke about companies. And company tax rate is different based on Indian or foreign, and surcharge rates are also different. Are we clear, everybody? Now, if I look at the concept of surcharge, some of them might be slightly surprised or confused with the concept of surcharge. I'll simplify the whole story for you. Don't worry. Listen very clearly. One category is for individual, HUF, AOP, BOI, AJP. Here what is the story? Here again we will divide into two categories. What are two categories again? That is default and optional. Correct, no friends? Come on, please tell me. Default, what is the answer? Total income is more than 50 lakhs. Come on. Total income is more than 50 lakhs but does not exceed 1 crore. Then it is 10%. And total income is more than 1 crore but does not exceed 2 crores. 15%. Total income is more than 2 crores, does not exceed 5 crores, 25%. And total income is more than 5 crores. Come on, friends. Total income is more than 5 crores. In default, it is 25% only, but in optional, it is 37%. And one important point to be noted is that in case of dividend, and in case of capital gains. In case of dividend and in case of capital gains, surcharge is capped at the rate of 15%. That means in case of dividend income or in case of capital gain income, the maximum surcharge is only 15%. Very interesting point, guys. Come on. Other side of the story, what is it? What is it now? Come on. In case of firm, LLP, in case of firm, LLP or local authority, what is the answer, my dear friends? Total income is more than 1 crore, straight away 12%. Next one. For cooperative society. For cooperative society, what is the answer? Total income is greater than 1 crore, does not exceed 10 crores, 7%. Total income is greater than 10 crores, then it is 12%. Next, last category, my dear friends, company. And in company, we have two types. domestic, the other one is foreign. Domestic, what is the answer? If you observe carefully, domestic, the answer is same as cooperative society. No difference at all. More than 1 crore, not more than 10 crores, 7%. More than 10 crores, 12%. And foreign company, my dear friends. Foreign company, what is the answer? Total income more than 1 crore, not more than 10 crores. It is 2%. And total income is more than 10 crores, then it is 5%. That is the story of the concept of surcharge. A very clear-cut point, my dear friends. Very interesting and of course very important as well. Because the concept of surcharge is applicable only for a high income person whenever the income is beyond that particular limit. And I clearly told you there is some special concept called marginal relief which will come into picture when extra tax is more than extra income. Now let's take some examples here. Listen very clearly, sir. Sir, let us say for example, PQR Limited an Indian company. Okay, my dear friends. Let us say total income is exactly 1 crore. We'll calculate tax at what rate? 25%, assuming that it is not opted for section 200 and assuming that turnover in brief that 24-25 is not more than 400 crores, which comes to how much, my dear friends? 25 lakhs. Surcharge nil. Total 25 lakhs. We will add HEC at 4%, which comes to 1 lakh. And total figure is turning out to be 26 lakhs, my dear friends. Now tell me, other way around. Assume for a second, total income is 1 crore 1 lakh. How much is total income, sir? 1 crore 1 lakh. Tell me, how do we calculate tax? Tax at 25%, which comes to 25 lakhs 25,000. And I will add surcharge at the rate of 7%. Because if it is more than 1 crore, not more than 10 crores, 7%. More than 10 crores, 12%. Already we know this. 25 lakhs 25,000 into 7%, which is coming to 1 lakh 76,750. 25 lakhs 25,000 plus 176,750. It is coming to 27 lakhs 1,750. That is my figure. Now tell me, between 25 lakhs and 27 lakhs 1,750, what is the difference in tax, my dear friends? It is 2,01,750. Whereas difference in income is equal to 1 lakh. Now please tell me, just because we earned 1 lakh more, will government ask you to pay 2,01,750, sir? That's ridiculous. So very clearly what will happen? We will get something called marginal relief. And how much is marginal relief, my dear friends? Marginal relief is always extra tax minus extra income, which is 2,01,750 minus 1 lakh, which comes to 1,01,750. And total figure comes to 26 lakhs. And I will add HEC at the rate of 4%. 1,04,000. Friends, always keep in mind that marginal relief is to be taken before HEC only. What is that I just told? Marginal relief is to be taken before HEC only. So total figure is 27 lakhs 4,000. Now let's say for example, I'll continue this. If total income is 1 crore 10 lakhs, Tell me guys, how much will be the tax at 25%? 27 lakhs 50,000. And I will add surcharge at 7%. 27 lakh 50,000 into 7%, which is coming to 1 lakh 92,500. 27 lakh 50,000 plus 192,500, it is coming to 29 lakhs 42,500. Now tell me, extra income beyond 1 crore is equal to 10 lakhs. Correct, no friends? And what is the extra tax, my dear friends? Extra tax is 29 lakhs 42,500 minus 25 lakhs, which is coming to 4 lakhs 42,500. Tell me guys, what is the extra income? 10 lakhs. What is extra income? 10 lakhs. What is the extra tax? 4 lakh 42,500. And you please see my interesting line here. That is, marginal relief is equal to nil. Because the concept is very clear that marginal relief will come into picture only when extra tax is more than extra income, which will happen generally when income is slightly, what is that word? Slightly beyond the limit of surcharge. So here marginal relief will not come. So I'll directly add HEC at the rate of 4%. 29 lakhs 42,500 into 4% is coming to 1 lakh 17,700. 29 42,500 plus 1 lakh 17,700, which is coming to 30 lakhs 60,200. Which is my total tax payable. I am pretty confident and sure that after this example, we got complete clarity on marginal relief, and we also got complete clarity with respect to the concept of surcharge. Are we clear, everybody? Excellent. Friends, now that we got complete clarity with respect to surcharge and with respect to marginal relief, let me discuss some more interesting points and complete this first chapter known as basic concepts, which will definitely come in exam short, my dear friends. Let me explain some interesting and important concepts to you here. Are you all ready? Listen. Sir, I am going to discuss with you some important concept called the tax rates for capital gains. Tax rates for what, my dear friends? Capital gains. Listen very clearly here, friends. Sir, in capital gains, there is something called long-term capital gains and short-term capital gains. Now the question is all about, when do we call something as long-term capital gain? When do we call something as short-term capital gains? It clearly depends on something called period of holding the asset. So for example, sir, in case of land and building, I repeat, in case of land and building, if you are holding that land and building for more than 24 months, if you are holding that land and building for more than 24 months, it is known as long term. But if you are holding that building or land for less than 24 months, then it is known as short term. So long term or short term clearly depends on something called period of holding, how long you are holding that asset. In detail, we will talk when I go to the chapter called income from capital gains, which is a part of our syllabus. Come on. So for long-term capital gains, and one more doubt can come. So what about shares? That is also capital gain only. And when do we call it long-term, short-term? Generally for listed shares, what we tell is that if you are holding that share for more than 12 months, we treat it as long-term. If you are holding for less than 12 months, we treat it as short term. Getting clarity, everyone? Come on, please here. So what is long term, what is short term, we'll talk in detail separately. Don't worry. Long term capital gains, general rate is equal to 12.5%. But there is some special case of land and building where it is 20%, which we'll talk in detail when I go to the chapter called capital gains. Don't worry. But general rate is 12.5%. But if there is a long-term capital gains, on sale of equity shares or units of EOMF. EOMF stands for Equity Oriented Mutual Fund. So I am sure you all know what is mutual fund. Don't tell subject to market risk. So mutual fund, what happens is that when people put money in mutual fund will in turn put that money in various companies. So if they get profit, they'll give profit. If they get loss, they give loss. That's why we call it as subject to market risk. And in mutual fund, that's why they don't give shares. They give something called units, because you are acting as an investor. It's a pool of investors coming together. It's a pool of units, and fund will invest somewhere else. And when do we call a fund as equity oriented mutual fund? Equity oriented mutual fund is that mutual fund which invests 65% in equity shares of domestic company. In equity shares of what company? Domestic company. Then we call it as what, my dear friends? Equity oriented mutual fund. We'll talk in detail again in capital gains. Don't worry. So long term capital gain on sale of equity shares or units of equity oriented mutual fund or units of business trust. Business trust, something like similar to mutual fund only. Business trust through recognized stock exchange, example BSE or NSE, through recognized stock exchange on which STT is paid. Sir, STT stands for what? Securities Transaction Tax. I'm sure you know that. On which STT is paid is taxable at the rate of 12.5%, same rate only, but 12.5% on amount exceeding 1,25,000. And 1,25,000 is not per transaction. 1,25,000 limit is per annum. So for example, say Mr. X sold shares of Reliance through stock exchange. And obviously STT is paid. It is mandatory. It's not an option. Yeah. And there is a long-term capital gain of, let us say, 3,50,000. Law is telling tax will be equal to 3,50,000 minus 1,25,000 into 12.5%. So 3,50,000 minus 1,25,000 is coming to 2,25,000. On that 12.5% is coming to 28,125. That becomes the amount of tax. Clear? Next, get back other side. Short-term capital gains. Listen. I'll do something interesting. Please see here. Same scenario. Instead of long term, it is short term capital gains. What they told in the law is it is taxable straight away at the rate of 20%. So if it is long-term capital gains on sale of equity shares or units of equity-oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid is taxed with a rate of 12.5% on amount exceeding 1,25,000. Same scenario, instead of long-term, if it is short-term, we will tax at the rate of 20%. And finally, last point, any other short-term capital gains. What is that line, my dear friends? Any other short-term capital gains. Any other short-term capital gains is taxable at slab rates. In other words, instead of writing slab rate, I will write it as normal rates. Normal rates is nothing but slab rates, what we discussed some time back. If it's a partnership firm, 30%, company is that 25, 22%, foreign company 35%, same story. Whatever we discussed, that only will apply. Very, very interesting concept. See here, 196, short-term capital gain on listed securities with STT. What rate, my dear friends? 20%. 197, long-term capital gain, 12.5%. 20% with indexation, special case is there, that we'll talk separately. 198, long-term capital gain on listed equity or equity-oriented funds, 12.5% on gains exceeding 1,25,000, STT paid. So that is the story of this interesting concept, and this short-term is given by section 196, long-term general rate section 197, and long-term special rate section 198. Clear? Let me take an interesting example with capital gain so that full clarity will come. Let us say, for example, there is one person, Mr. X, whose total income is 60 lakhs, which includes long-term capital gain on sale of land, which is equal to 20 lakhs. Okay, my dear friends, sale of land 20 lakhs. And the question is, compute tax under default tax regime. Come on, how do we calculate tax under default tax regime, my dear friends? Friends, please tell me. First of all, on 20 lakhs, we will tax at the rate of 12.5%. Yes or no, my dear friends? On 20 lakhs, into 12.5%, which is coming to 2,50,000. And on balance 40 lakhs, we will apply slab rates. Correct, no, my dear friends? How do we compute in slab rate? Come on, please tell me. Up to 4 lakhs, nil. 4 lakhs to 8 lakh at the rate of 5%, which comes to 20,000. 8 lakh to 12 lakh, 10%, which comes to 40,000. 12 lakhs to 16 lakhs at the rate of 15%, which comes to 60,000. Friends, correct? No, friends. 16 lakh to 20 lakh at the rate of 20%, which comes to 80,000. Next line. 20 lakh to 24 lakhs, 25%, which comes to 1 lakh. And more than 24 lakhs at the rate of 30%. More than 24 lakhs, what is the figure? 16 lakhs into 30%, which comes to 4,80,000. Total figure is 7,80,000. So my total figure is, total tax is 7,80,000 plus 2,50,000, which is coming to 10,30,000. That becomes my tax figure. Friends, I am sure we are getting clarity. And to that, I will add surcharge at the rate of 10%. Why surcharge has come? Surcharge has come because total income is more than 50 lakhs. So that means we have to separately do for capital gain, and then balance we have to apply slab rates, because for capital gains there is a special rate of tax. And the special rate of tax is given by section 197. 196 is for short term, 197 is for long term, 198 is for long term only STT paid. Surcharge at 10% comes to 1,03,000. Total figure 11,33,000. And I will add HEC at the rate of 4%. 11,33,000 into 4%, which comes to 45,320. 11,33,000 plus 45,320 is coming to 11,78,320. This is my total tax payable. I'm pretty confident and sure that you guys have got very good clarity on section 196, 197, 188, which talks about tax rates for capital gains. Clear, everybody? Excellent, guys. Come on, get back. So we are done with 186, 187, 188. Next section 194, my dear friends. In case of lotteries, gambling, online games, and also in case of horse racing or any kind of games, my dear friends, the tax rate is flat 30%. When I say flat 30%, no limits. Straight away 30%. Clear, friends? Very important point. So in case of betting, gambling, lotteries, crossword puzzles, card games, horse racing, these are all technically actually known as casual incomes, my dear friends. So in case of casual income, the tax rate is 30%, which is given by section 194. We have one point which we left in between. We'll complete that also. Please come there. Please come to page number 10. Undisclosed or unexplained income. Sir, there is some income or there is some property what you purchased, there is some investment what you made, and government is asking what is the source of investment. When department is asking source of investment, you are telling, sir, somewhere I got. Now what is this somewhere nonsense? Source has to be explained. If you don't explain that source, it is called unexplained income or unexplained investments. Please see that. Where the amounts are found credited or invested or spent, and assessee offers no satisfactory explanation about their nature and source, they are deemed to be income of that tax year. What are the possible cases, sir? 102, 103, 104, 105, 106. Earlier, old sections were there. And what it covers? Unexplained cash credits. There is a cash credit in the books. From where you got, you're not able to tell. Unexplained investments not recorded. Unexplained money or asset or recorded below the actual value. Actual value is 1 crore. In books we are showing as only 30 lakhs. Unexplained expenditure. In P&L account, there is a staff welfare of 10 lakhs. But the staff is only one. With one staff, what 10 lakhs welfare you have done? Explain. So you cannot bluff government just like that. Amount borrowed or repaid on hundi. Sir, hundi is a negotiable instrument. Other words, it is like a bill of exchange. A negotiable instrument which is drawn in local language. A negotiable instrument drawn in local language is known as a hundi, which is like a bill of exchange. Clear, friends? What are cases we covered? Unexplained cash credit, unexplained investment, unexplained asset or money, unexplained expenditure, amount borrowed or repaid on hundi, otherwise than by account pay check. Sir, I'm sure you all know there are three types: bearer check, cross check, account pay check. Bearer, whosever name is written, they can take the money. Cross check, only 2 lines are drawn, but it can be endorsed to some other person. Endorsed means transferred to some other person. Account pay check, generally where we draw 2 lines and in between we write account payee. So the money will directly go to that person only, but not to any other person. That's called an account pay check. So all these cases, my dear friends, 102, 103, 104, 105, 106, all these cases, it is taxed at the rate of 30% as per section 195. 194 we have done. What is 194? Betting, gambling, lottery. 196, 197, 196, 197, 198 is also done. 196 is short term, 197, 198 is long term capital gain. As per section 195, plus surcharge at the rate of 25% plus cess 4%. Effective rate is 39%, my dear friends. No basic exemption and no deduction for any expenditure or allowance is allowed. And there cannot be no set off of loss against such income. You cannot tell, I have some other business loss, I will set off with this income and then balance I'll pay 30%. Not allowed. Clear, friends? Very, very interesting point. No doubt about it. So, my dear friends, if you observe carefully, what are all the points we covered in this particular topic? We discussed 211, who is assessee. 277, who is a person. 252, definition of India. Then we covered section 3, tax year. Section 4, charge of income tax. Friends, correct? No. Then we spoke about something called sections 317. We covered 317, 318, 319, 320. 316 as well. What is 316, my dear friends? Shipping business of non-resident. 317, person living in India permanently or for a long time. 318, AOP, BOI, AJP formed for short duration or purpose. 319, person likely to transfer property to avoid tax. 320, discontinued business. These are the 5 cases where we clearly spoke about cases where income of a tax year is charged to tax in the tax year itself. And we have also covered definition of income as well, 249. Friends, are we clear with all these points? Then we have covered section 5 and 6 as well, that is rounding off. Then we spoke about section 13, heads of income. 5 heads of income are there. House property, salaries, correct? No, salaries, house property, PGBP, capital gains, other sources. Then we covered section 202, default tax regime. Then we have covered section 156, what is that? Rebate. Then we have covered section 200. 200 is what? Optional payment of tax for domestic company at 22%. Then we have covered section 194, 195, 196, 197, 198. And what is 194? Tax on betting, gambling, lottery. 195, my dear friends, unexplained incomes, investments tax at 30%. 196, short-term capital gain. 197, 198, long-term capital gains. So these are all the interesting sections what we covered in this particular topic, my dear friends. And of course, section 11 is exemptions. And deductions are given by chapter 8. 5 and 6 is rounding off of income. 156, of course, rebate. Then section 200 was there. 196, 197, 198, 194. That's it. I'm pretty confident and sure that we got very good clarity on this interesting concept called basic concepts of income tax. Very important. But this chapter is not just the basic. It is a platform for the entire income tax syllabus what we are going to cover. Because everything revolves around this. That's why this chapter is extremely important. No doubt about it. See some points. Practice questions. X starts new business on 29th March 2027 and closes his first books on 31st March 2028. How can you close 31st March 2028? The answer is books have to be closed on 31st March 2027 only, because tax year will end by 31st March. Next question. Mr. X resident age 30, has for the tax year 26-27 salary of 5,05,000, savings bank interest of 8,000. He has deposited 50,000 in PPF and pays tax under optional regime. Compute his tax liability. What would be your answer if it is default tax regime? Sir, if you observe carefully, there is salary of 5,05,000, interest on savings bank account of 8,000, total figure 5,13,000, and from that, my dear friends, what we will do is we will take deduction under chapter H. And what is the deductions we will take? In the question, if you see, they told that he has deposited 50,000 in PPF and paying tax under optional. And we are also asking what is the answer if it is default. Sir, under deduction under chapter 8, my dear friends, for deposit in PPF, we get the deduction subject to maximum limit of 1,50,000, which we'll talk in detail separately. And for interest on savings bank also, there is a deduction of actual interest or 10,000, whichever is lower. Actual interest or 10,000, whichever is lower. Friends, for interest on savings bank account also, we get deduction of interest or 10,000, whichever is lower. I'll tell you what here, so that clarity will come for you as well. Listen, sir, there is one section called section 123, which gives deduction for deposit in PPF, Public Provident Fund, and 123 covers various cases like life insurance premium, Public Provident Fund. So many points are covered there in 123. And 123 has got a maximum limit of 1,50,000. And this deduction I am taking because we are talking about optional tax regime. And there is one more section called 153. Which section, my dear friends? 153, which says deduction for interest and for savings bank interest for non-senior citizen. For what citizen? Non-senior citizen, we get the deduction of interest or 10,000, whichever is lower. If he is a senior citizen, we will get deduction of interest or 50,000, whichever is lower. In the question, if you see, the age is 30 years. So it is non-senior citizen. It is what citizen? Non-senior citizen. Friends, correct or not? Exactly. So this deposit in PPF, I have taken deduction as per which section? Section 123. Interest on savings banks, I have taken which section? 153. And from 5,13,000, let me reduce 58,000. Balance figure is 4,55,000. And we are required to compute the tax. Under what regime? That too under, definitely under optional regime. Obviously because I have taken deduction. Come on. But in the question, did they say resident individual? Yes. Mr. X is a resident individual. Correct, no friends? He is a resident individual. Total income does not exceed 5 lakhs. So hence what will happen, my dear friends? Rebate is allowed. Friends, are you getting clarity? So how do I compute the tax here? Up to 2,50,000, it is nil. 2,50,000 to 4,55,000. At the rate of 5%, which is coming to 10,250. So total figure is 10,250. From that I will reduce rebate under section 87A. 87A, which is tax payable or 12,500, whichever is lower. Rebate is tax payable or 12,500, whichever is lower, because we are in optional tax regime. So net tax will be nil. This is the story of what regime, my dear friends? Optional tax regime. But the same story, if it is default tax regime, then section 123 and section 153 deductions are not allowed, and tax to be computed on 5,13,000. And how do I compute the tax, my dear friends? Come on, please tell me. Up to 4 lakhs. Friends, correct? No, friends. Up to 4 lakhs, nil. 4 lakhs to 5,13,000 at the rate of 5%. That is nothing but 1,13,000 into 5%, which is coming to 5,650. Total 5,650. And one small change, rebate section is not 87A, rebate section is 156. 87A is the old Income Tax Act under 1961. Yeah. So 5,650. From that, I'll reduce rebate under section 156. And how much is the rebate, my dear friends? In default tax regime, if you are a resident individual and your total income is not more than 12 lakhs, you will get a rebate of tax or 60,000, whichever is lower. And the rebate will be 5,650. And net tax payable will be nil. That is the story of this interesting question. Make sense, guys? Can we do the examination? Are we perfect with computation of tax rate, my dear friends? Excellent. Get back. Third question. Mrs. X is a resident for tax year 26-27 with income chargeable to tax 15,54,810. Find out her taxability under both the regimes. If the age is 59, age is 60. If it is default, we are not concerned with the age. If it is optional, then age criteria will come. If it is 59, first category, 60, second category. You please solve it. This question is for practice. Any doubt? You please comment, I'll reply. Okay? Next. Fourth question. Compute tax liability of X Limited, assuming total income is 1 crore 1 lakh. This is already solved, because in my example, I already gave this concept. Next. Write a short note on income accruing and income due. Can income taxed on accrual be assessed again on receipt basis? So, fifth question. Income accrue refers to right to receive. Income due means right to enforce the payment. So, for example, I'll write one line. Salary is accrued on daily basis, but it is due at the end of the month. It is accruing on a daily basis, my dear friends, but end of the month only it is due, sir. And one more question, one more point, what they asked, can income tax on accrual basis be again assessed on receipt? Sir, once you tax on accrual, why will you tax again on receipt basis, sir? You are interest students, I did not tell you this. Next. Explain what is average rate of tax. Average rate of tax is nothing but tax divided by income into 100. You will get your average rate of tax. Other one, what is maximum marginal rate? maximum marginal rate refers to the highest rate of income tax. And the highest rate already we know is 30% plus surcharge plus HEC. Clear? Next. Who is an assessee? Who is deemed assessee? Who is assessee in default? Already we have done section 211. Assessee means any person liable to pay tax and includes every person in respect of whom proceedings have been taken up for assessment of his income or loss sustained by him or refund due to him or assessment of income of any other person in respect of which he is assessable or loss sustained by such other person or refund due to such other person. And assessee also covers deemed assessee, and it also covers assessee in default. Assessee in default covers three cases: person who has not done TDS, person who has done TDS but not paid to government, person who failed to pay advance tax. Next, explain the concept of marginal relief under income tax. That is also done. Marginal relief will come only when income is slightly beyond the limit of surcharge, and marginal relief is always extra tax over extra income. So that is the story of this interesting concept of the first chapter in income tax basic concepts. Something very important, high probability that a question will trigger in the examination. No doubts.